Minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
Here are your top stories. Central bank chiefs try to reassure the markets over inflation, even as fuel prices surge and iron ore jumps more than 10%. French CPI this morning comes in at 2.1%. The UK economy grows 5.5% in the second quarter, above forecasts. But as the nation grapples with a volatile currency and a supply chain crisis, is it still a good bet for investors? And Senate Majority Leader Chuck Schumer says a deal has been reached to avoid a U.S. government shutdown this Friday, but key risks to President Biden's economic agenda remain.
Now let's take a look at the futures. Tom, a lot of the focus, of course, is on the fact that the U.S. has averted a government shutdown, so that's giving a nice little lift to the markets. Also, the central banks at pains, 4 of them, of reminding us transitory inflation. Transitory, Tom. It's not sticky. The markets don't quite believe it.
Yeah, and a key line there from Jay Powell, I thought, was he said, we don't know how it's high it's going to go, essentially, and we don't know for how long. So the definition of transitory remains in flux. The UK is in focus, of course, given that GDP print coming in above the surveys. The surveys were for 4.8%. As we said in the headlines, we've got 5.5%. The money market's pricing in 3 rate hikes here in the UK by the BOE in 2022. You're seeing gains of 0.5% on the FTSE 100. It's also a strong first few seconds for the CAC 40 gains there of 55 points, up 0.8%. We had the CPI print that we mentioned in the headlines, and PPI as well, coming in slightly below the estimates month on month, 1%. Year on year, 10% though, in terms of producer prices. In terms of Spain, you're looking at gains of 0.8% there, 70 points on the IBEX. Let's turn at the table and have a look at what's happening across the sectors here. The energy prices back in focus in terms of record highs again here in the UK in terms of gas prices. We talked about the utility sector and more of those companies going to the wall on the back of these very high prices. Energy currently up 0.3%. Utilities gaining 2 points, up 0.6%. Banks, again, you're looking at a 10-year yield of 1.53. The yield story and the financials, the beneficiaries of this, even as tech sells off in the US, gaining 0.7%. Technology here in Europe, though, gaining 1%. So you're seeing some upside for technology, despite the fact that over in the US, you saw the NASDAQ closing lower for 3 straight days. Francine.
Yeah, Tom, European equities actually opening higher. That's after a rebound in U.S. tech stocks fizzled out to see the NASDAQ post a 3rd consecutive loss. Now, investors contending with weak data out of China, skyrocketing energy costs around the globe, and at the ECB's forum on central banking, Jay Powell and others insisted that price increases would be transitory.
This inflationary spike will not lead to a new regime of ongoing higher inflation. The current inflation spike is really a consequence of supply constraints meeting very strong demand.
We certainly have no reason to believe that this price increases that we're seeing now will not be largely transitory.
Excluding the temporary factors like this one, the underlying inflation is not so weak as the headline figure.
The preferred tool will always be rates, because we understand the effect. The effect of rates in the monetary transmission mechanism is much better understood. That's not to prejudge what we will decide in November.
Well, joining us now to talk about inflation and the markets, Florence Barjot, Chief Investment Officer at Lyxor Asset Management. Florence, thank you so much for joining us this morning. Unclear to me what a catalyst for a correction would be in the markets. Is it the Fed, or is it some other central bank policy mistake or adjustment, surprise, or actually is it valuations?
I think you have, equity markets have been confronted to a kind of wall of worries in recent weeks, and you've mentioned some factors which are very important, and all of them, could concur and are concurring to increasing uncertainty at the current stage. But for me, the real story is really about inflation, and it's interesting because we've been talking about inflation since the start of the year, but the picture has changed somewhat. At the start of the year, markets were oscillating between inflation and growth fears, meaning that inflation could be higher than expected because the economy was accelerating, because we had significant stimulus coming from the fiscal side, coming from the monetary side, and growth fears were more related to downside growth issues, to COVID typically. And what we're seeing today with all these stories on supply side issues, energy prices, is that inflation is going to be higher than expected. Temporary is going to be longer than expected, and above all, higher inflation could come hand in hand with lower than expected growth. So this story is really different, and it's a headache for central banks, and it's a headache for markets, because obviously higher inflation and weak growth, stagflation basically, should not be treated the same way as high inflation with a strong growth.
I want to get your views on what Cathie Wood has been saying about deflationary pressures. I know you're talking about a narrative change when it comes to inflation. You've just outlined that very clearly for us. But ARK Investments, Cathie Wood, saying that her concern is deflation. Take a listen.
I'm not sure that
there are a lot of value traps populating traditional benchmarks today, and the value traps there are going to be significant downside surprises because of all of the disruption and disintermediation we see taking place in the world today, thanks to technologically enabled innovation. And so the other big, this is a combination of, innovation call, but it's also a call on the corporate bond market. Watch out, watch out.
Okay, Florence, I want to get your views on technology, the role that technology plays in potential deflationary pressures. Are we underestimating that as a potential catalyst or counteract the inflation pressures that we're seeing now? Is this a longer-term story?
No, actually, I think it's an old story, that technology, that progress is pushing prices down. I mean, this is what we've seen during the whole great deflation of the last 10 years. I mean, innovation, productivity gains, these tend to be deflationary, and that's what we have been trying to exit, with all the central bank stimulus. In my view, the story which is coming up today is much more that of price pressures which are linked to supply chains. Well, of course, part of it is going to be temporary, but we're also seeing, what's happening in China, for instance. China is trying to rebalance towards cleaner energy. They have as a target to be carbon neutral by 2060, and that does imply a strong industrial change in the way you produce goods. And we see this in other countries too. So potentially there is here something which could drive prices higher, and deflation for me is not really on the cards today.
Florence, what would you buy right now? Is there something that either looks undervalued or looks cheap, or is there something that you think the market hasn't really quite focused on?
No, it's a good question, because actually a lot of things look expensive, and what we're doing in the portfolios today is much more not buying things, but cutting risks. So the big trend in our portfolios today is protecting against a correlation shock. We manage multi-asset portfolios, and we know that episodes where rising rates and declining equities are obviously very difficult for those kind of portfolios. So a good way to protect is first, to reduce exposures. And then obviously we're looking for what we can call anti-fragile assets. Convexity protections are one of them. We're looking at the US dollar. We like the US dollar because we tend to think it's a kind of a win-win asset at the current stage, because if inflation overshoots, if rates go up, well, the dollar should benefit. And if there's a massive risk off, it's going to have a safe haven protection. So we like the US dollar. And we also like Chinese sovereign debt. The Chinese state is very solid. The yuan has been very stable, and we still get, some positive returns on that asset class. So these are the kind of things we're looking at.
Okay, the US dollar and Chinese sovereign debt. Florence Barjot, CIO at Lixor Asset Management. Thank you. Let's switch focus to the UK. The government is ending 2 of its pandemic-era safety net programmes that pumped almost £80 billion into the economy. Over the next week, furlough support for wages and a temporary increase in benefits, both are due to finish. Together, they softened the blow of successive lockdowns here and prevented a spike in unemployment. Joining us now is UK economics reporter Lizzie Burden, who's been across this story for us, of course. The 2 programmes, Lizzie, set to end then. What happens now?
Well, Tom, economists have been warning for months that we could see a spike of unemployment when the furlough scheme ends, but there was no sign of that in the latest jobs data, and the Bank of England doesn't expect one. What's more likely is the older workers who were left on furlough on lower incomes will be pushed into early retirement, and you could see a rise in underemployment with people going back to their old jobs but now on fewer hours. There has been some sign of hope in the labour shortages, that the record vacancies that we've been seeing, but if you look at this chart, it's hardly likely that the waitresses will overnight be able to go and be builders. So there are some who argue that the furlough scheme should be extended. Places like Germany that already had similar schemes are going to keep on the schemes longer than the UK will, but given that the UK's budget deficit already reached a peacetime high last year, given that the Chancellor Rishi Sunak's already reining in the public finances by raising taxes, it hardly seems likely that he's going to change his mind now. What's more likely is a focus on skills and some giveaways on the cost of living. Bloomberg Scoop last night were expecting grants on the cost of living to the tune of £500 million.
I mean, £500 million doesn't seem like that much, Lizzie, so what are the risks to the UK economy?
Well, we're still not sure what's going to happen to that rump of 1 million or so workers who were left on furlough at the end of the scheme. But don't forget, it's not just furlough that's ending, it's also this temporary uplift in universal credit. It was £20 a week, it benefited about 6 million people. And together, ending those schemes is going to put pressure on household finances at a time when inflation's rising and growth is slowing. So there's a real risk that you could see a combination of the supply disruptions, of which the fuel shortages are only the latest symptom, combining with weaker household spending, weaker consumer confidence, and that could stick the economy into reverse and widen the gap between rich and poor.
Okay, Bloomberg's Lizzie Burden on the end furlough here in the UK. Still with us is Florence Pajot, CIO at Lixor Asset Management. Florence, how do you think about the pressures on the households here in the UK, as Lizzie was outlining there for us, and now how that informs your views about UK equities?
Yeah, I tend to agree with a lot of what Lizzie has been saying. The issue in the UK and in other countries actually is that consumers are confronted with rising prices and with diminishing purchasing power. Energy prices are just, the latest example of that. And what we're seeing is that the government is probably going to have to step in. In the UK, the difference is that, and actually it's difficult to understand, both the UK government and the UK central bank have tended to be much more hawkish than the ECB, for instance, or even the Fed. So assessing UK stocks in that kind of environment, I find it very difficult, to position positively on that asset class, because the way we see the UK today is that it's very close, to making a policy mistake. I don't think, that support should be cut too soon, and potentially this is going to weigh on UK stocks. And we do see also a lot of volatility in the pound, because traders don't know in which direction they should position.
Yeah, I mean, some even linking pound to actually an emerging market currency. Florence, thank you so much. Florence Barjou there, Chief Investment Officer at Lixor Asset Management. Now, coming up, skyrocketing gas prices push UK energy firms to breaking point. As 3 more suppliers collapse, the pressure mounts on the government. So we'll have all of the latest next. This is Bloomberg.
What have we learned from this ever-growing crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we've seen many events, right? Maybe in the fintech sector, and education, casino, and property. So I think diversification and help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike because of the sentiment. The evergreen is hurting the sentiment and people don't want to buy. And other developer, because they want to get cash.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Welcome back to the Open, everyone. 15 minutes into the European trading day, and actually we're holding firm to some of the gains we're seeing on the equity markets. Now, partly is because of the belief that there has been an agreement in U.S. politics, so maybe a sigh of relief at the margins because of that. And then we talk about inflation, and again, the four major central banks saying that actually inflation is still transitory. So we look at some of these stocks. I think actually, one of them, I think the FTSE is only gaining some 0.1%. Now let's take a look at what's on the move this morning. And Tom, I'm looking at H&M. Now, this is an interesting company. Of course, it's a fashion company. It's a Swedish clothing retailer. It's huge. A lot of efforts on sustainability. Many critics say they don't go far enough, but it reinstated its dividend as a Swedish, company says that prospects, so growth will improve following a pretty unprofitable quarter earlier this year because of the pandemic.
Different picture for the offline retailer Boohoo. So they are, you can see share prices down quite considerably there, more than 10% for Boohoo. So second quarter revenue growth of 9%, just 9% was, quote, materially below the consensus expectations for 28% growth. So 9% versus a consensus of 28%. They had a tough quarter. Physical stores reopening, so their competition is back on the high street. Consumer uncertainty, and then question marks and supply chain constraints as well. Those delivery timeframes being affected by the pandemic. The stock down more than 10% for Boohoo, Bram.
Now, let's also look at Diageo. A lot of people in the pandemic, didn't drink less necessarily, but drank more at home, which means that they bought less bottles in bars because bars were closed, and that means smaller margins for Diageo. Diageo is saying operations in Europe are now recovering ahead of forecast, and they see organic margin benefit, operating margin benefit from a recovery in sales. So they're basically saying they're seeing a strong start to their fiscal year, and Diageo gaining 2%. Now, the UK energy crisis is deepening. 3 more suppliers were pushed out of business yesterday by sky-high natural gas prices. More than 1.7 million customers have lost their energy provider since August. Now, the latest failures are adding pressure on the government to step in. Joining us now is Bloomberg's energy reporter, Rachel Morrison. Rachel, about 233,000 households depended on those 3 energy companies. So what happens to them?
Yes, while these energy companies are still the small ones, it's disruptive for their customers. So Ofgem, the regulator, advises people not to do anything, don't switch, and they will now find a new supplier for those customers. But as you mentioned, there are now a lot of customers that have been forced to switch supplier, and the balance sheets of the companies that take on those new customers are being stretched by the costs that they have to pay up front to take the customers. The companies can later claim back some of those costs, but they say that putting the money up front, that cost is stretching them, and they're getting towards breaking point where they don't want to take on any more new customers. And that's where the dialogue with the government is ongoing as to how they're going to deal with that.
Is there a tipping point for the government where they are forced, they are compelled, despite their ideology within the Conservative Party, to step in and support these businesses?
There's been a lot of debate about this, and at the moment there is a measure called Special Administrator, where Ofgem, the Treasury and the government step in and take on the role of the energy company. And in that scenario, they would be the supplier to people. So that's a way of almost nationalising companies. That would only happen if a big supplier fails, or if a lot at once with millions of customers fail at the same time, and the burden is too much for companies to take on. But they do have that tool, and the business secretary, Kwasi Kwarteng, has said he's prepared to use it, and that's what it's there for. So at the moment, they're not at that point, but more failures. We've had 10 companies go under, and this all adds to the pressure and takes us towards that point where the government may need to step in.
Okay, Bloomberg's energy reporter Rachel Morrison, thank you, on the impact on utilities here. Coming up, China's factory activity contracted in September. That was for the first time since the pandemic began last year, a sign of the damage that the electricity crunch in that country is having. That story is next. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Welcome back to the Open. We are 22 minutes into the European trading day. The gains that we saw at the early start of the Open are looking a little less convincing. You're still seeing 0.7% gains across the stocks at 600. The UK is gaining 0.5%. GDP coming out slightly stronger than expected. In terms of investors and the BOE pricing in 3 rate hikes in 2022. And as Fran has been mentioning, of course, the central bank is coming out and trying to reinsure about inflation. Let's switch focus to the data out of China, which this morning shows that factory activity contracted this month for the first time since the pandemic began. It is the latest sign that the growing power crunch is really starting to hit businesses there. Joining us now is our executive editor for Greater China, John Liu. John, what does the data tell us then about the outlook for China's economy?
So it's sort of starting to diverge. We have on one hand these heavy industrial companies that are really suffering from this power crunch. We have more than half the provinces starting to limit the amount of electricity that they supply to industrial users. That sector is really slowing. The National Bureau of Statistics, which put out that PMI, pointed to that sector as being one of the main drags on the PMI this in September. And on the other hand, you have exporters. We have export growth in double digits, 20%, growing 20% a month, and that sector is continuing to boom. So it's sort of a divergent picture, two different pieces of the economy going in different directions.
John, what can you tell us about Beijing telling the banks to help stabilize the housing market?
So one of the big worries for Beijing is contagion from the Evergrande saga. The big worry is, as Evergrande is trying to raise as much money as it can, it's cutting the prices of its homes by significant amounts to try to offload them and turn that into cash. The worry is that's going to force other developers to also cut their prices, and that's going to be sort of an avalanche effect, and you're going to see the broader market for homes take a tumble. The government is coming in and telling banks that they should continue to lend to property developers to make sure that they have the necessary capital, continue building homes that they've already sold, and also asking local governments to ensure that the property market stays stable.
Central to the property market, of course, in China right now is the plight of Evergrande. John, October the 11th, they've got more bond payments due. Is that where we should be looking for the next point of tension for this company?
There is a bond that is due this Sunday. Because it's Sunday, the due date will be on Monday, but that bond, the holders are arguing Evergrande is on the hook to pay because it guaranteed the bond. So we are watching out for that. That is a principal of the bond that is due on Sunday, so it's a bit different from just a coupon payment. But also a little bit further down the road, Evergrande, as far as we understand, is yet to pay a coupon that was due September 23rd. There's a 30-day grace period on that. That 30 days should end about October 23, and so if Evergrande has not paid, there's a chance of default there.
John, thank you so much. Our executive editor for Greater China there, John Liu, and of course we follow every development, as Tom is also by my side, so we also look at exactly what's happening with coal plants as we go on to COP26. I mean, there's a lot of China data that, you know, markets struggle, I guess, to interpret because they move around a lot, and there's always that worry that actually what we are given as data is not the real thing behind the facade.
Yes, the NBS, the National Bureau of Statistics, of course, would argue that they are getting better at providing kind of accurate statistics, but that concern, of course, remains for investors. So they try to get a grip on what is happening with China, the uncertainty there.
Now, coming up, a tale of two retailers. H&M shares rise after it announced its dividend resumption. Boohoo sinks after cutting its full-year guidance. So we discuss retail next. This is Bloomberg.
there is just a lot of demand right now for products, whether those be items for our home office or for backyard entertainment. This has been a consistent issue for the past year or so throughout various lockdowns. The global supply chain is made up of ships and trains and trucks, and it's designed for predictable patterns of demand, which is the exact opposite of what we have right now. A lot of uncertainty about whether certain economies are going to be open or closed based on the outbreaks that they're having. So we're just seeing a lot of confusion, a lot of chaos, and a lot of uncertainty disrupt the whole system. The auto industry is very reliant on semiconductors, these memory chips that are in basically everything we buy that has sort of an electronic component to it. And they come from certain economies in Asia like Taiwan, where they're having trouble meeting the demand. The supply chain issues are going to be around as long as you think the virus is going to be around. First or second quarter of 2022 is when a lot of people see the normalizing of all the shipping and transportation disruptions that we're seeing. But if they don't, we might be dealing with this for another year or two or three.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to The Open with 30 minutes into the European trading day, and here are your top stories. Central bank chiefs try to reassure the markets over inflation, even as fuel prices and iron ore surge. French CPI this morning comes in at 2.1%. The UK economy grows 5.5% in the second quarter, above forecasts. But as the nation grapples with a volatile currency and a supply chain crisis, is it still a good bet for investors? And Senate Majority Leader Chuck Schumer says a deal has been reached to avoid a U.S. government shutdown this Friday, but key risks to President Biden's economic agenda remain. So, Tom, if you look at the markets, a lot of the focus actually is on the fact that there is an agreement in Congress with Chuck Schumer, but then they don't really know what to do with this inflation trend.
Yeah, and that's part of the picture for the UK, isn't it? 5.5% of the GDP, fine, but is that as good as it gets? And what does that mean in terms of the conundrum for the BOE? You're absolutely right as well, of course, Francine, to point out the utility companies that have gone to wall. The energy prices continue. We've been talking with our guests about how that impacts households. And the question marks again then about the sustainability of the consumer, where they are so key to the economic trajectory of countries like the UK and the US. The Stock 600 are currently gaining 0.8%. Gains as well in Germany, 0.3%, slightly more muted than the picture we have across France, where you're seeing 40 points added to the board there, 6,600 for the CAC Garonne. Gains of 0.5 for the UK after that 5.5% GDP print. The markets, though, pricing in 3 rate hikes by the BOE in 2022 here in the UK. And then, of course, focus on sterling as well, currently up versus the US dollar. But it has been called by some, like the RBC, for example, been suggesting that maybe the sterling is acting a bit like an emerging market currency. Controversy there. Technology, top of the list, 1.5% after some sell-off. Of course, the US, the NASDAQ closing 3 straight days lower. Of course, the yields continue to grind higher, but it is the pace of that increase that maybe is giving some assurance at this point, at least, around the technology sector. It is not spiking. Those yields are not spiking at a particularly aggressive rate. In terms of what's at the bottom, autos and parts is the only sector that is in the red at the moment. It's essentially flat. Basic resources as well, worth flagging, given the iron ore is currently up more than 2% in today's session. Basic resources gaining 1.4%. Fran.
Tom, let's talk about retail. H&M reinstating its dividend as the company's prospects improve. Now, the Swedish clothing retailer says pre-tax profit more than doubled in the 3 months through August. It's a different picture, the Boohoo. Shares sinking this morning after the online retailer cut its full-year guidance. Well, joining us, let's go straight to Lisa Hooker, consumer markets leader for PwC. Lisa, great to speak to you on a day like today. I mean, the concern with retailers is that we can talk about the weather, the lockdown, the pandemic, and pricing, but it all boils down to whether you want to buy that product or not. So who's doing well and who's not?
Well, I think we've got to look back. Last year was really difficult. And we saw in the UK, we saw a 25% decline in fashion, and we saw it around the world. So when you're looking at results this year, people are now going out, going back to work, and actually not spending as much money on other things. So fashion has really come back as an important purchase for consumers around the world. So you are seeing quite a big bounce back by a lot of retailers. Now, if you take something like a Boohoo grew over 40% in the first half of last year. So they are going against strong comps. And because they're online only, you had really good results. So they've got some harder comparisons. So they are still doing well. And fashion is being prioritised at the moment. And I think that will continue as we go up to Christmas.
Lisa, how do you expect the furlough, the ending of the furlough here in the UK, to impact that consumer strength and therefore the read across to the retail space?
It is quite interesting because we've got about 1 million people coming off furlough the end of the week, but we actually have labour shortages going on. If you talk to a lot of the retail and hospitality sector, they can't get staff and they're really keen for the furlough to end to get hold of these people. So given unemployment is still actually relatively low and much lower than we expected a year ago, I actually think it's not going to be too bad. I do appreciate that there are some headwinds coming in terms of inflation, and there will be a little bit of an increase in unemployment, but fashion is still on a bounce back, and people have said to us when we've done our surveys, they want Christmas to be extra special. So I do think there'll be people looking to buy as we run up to Christmas.
Lisa, are we concerned, or are you concerned about supply chains also affecting actually some of the fashion retail in the lead up to Christmas?
I think there will be some impact from supply chains, and you've seen people like Next come out saying actually our stock is quite a bit lower this year than it was last year, reflecting not just supply chains but probably a better bounce back than we expected. So I think there will be a level of stock outs in certain areas, particularly when you're sourcing from places like China. But I think the retail sector has been so resilient through the pandemic, is they will look to make that up, by substituting products and also by sort of maybe doing less promotional activity so that they don't have the swings in stock levels that we might have seen historically.
Lisa, I want to ask about cotton prices and the impact on margins, whether or not these companies are able to absorb that pressure. You've seen cotton prices up, 40% year to date, or whether they have to pass that on to the consumer.
Whenever we see inflation, there's always a slight lag effect because you do a lot of negotiations a few months before a season. I think if you read a lot of results, people are saying that after quite a number of years of deflation in the fashion industry, often driven by promotional activity, we will start to see a level of inflation and price increases coming through. And you've seen some people announce, again, Next talked about, they actually probably have seen about 2% inflation. So I do think in the clothing market, we'll see a little less promotional activity and a little bit of inflation in pricing.
Lisa, when are you expecting Chinese tourists to come back to the UK, and how supportive will that be of UK luxury brands?
It's really interesting. I was talking to one of the luxury brands thinking that they would be desperate for the Chinese tourists back for their business. But a lot of them have said to me, actually, what we've done really well is engage with the Chinese consumer in China and actually have a much better relationship with them locally, because we can engage on a regular basis than we do when they come over for a holiday maybe once a year. So actually the impact hasn't been as great as you may think actually on the luxury sector. So they're not as concerned about it coming back. Now, obviously, we do need tourism back to the wider retail and hospitality sector, but I think the consensus is it's going to take quite a while to get back to the pre-pandemic levels.
Okay, Lisa, thank you for your time. Lisa Hooker, consumer markets leader for PwC, giving some insights on the retail space and the impacts on the consumer there, the demand picture as well. Let's get the first word news now with Laura Wright. Laura.
Thanks, Tom. The EU and US are still divided on tariffs on metals, a dispute going back to the Trump era. EU officials told reporters on the sidelines of the US-EU Trade and Technology Council meeting in Pittsburgh the issue was discussed, but a resolution has not been found so far. Trump imposed tariffs on imports of steel and aluminium in 2018. A former Goldman Sachs compliance analyst whose job was to help the bank prevent insider trading has been charged with insider trading by the U.S. Securities and Exchange Commission. The SEC claims Jose Luis Casero Sanchez used his position in the bank's Warsaw office to access confidential information to carry out trades netting him at least $470,000 in illegal profits. A lawyer for Casero Sanchez could not be immediately located for comment. The International Olympic Committee says no international spectators will be allowed at Beijing's 2022 Winter Games. It says tickets will be sold exclusively to spectators residing in China's mainland who meet virus requirements. The IOC also says athletes who are not fully vaccinated will have to quarantine for 21 days upon arrival in Beijing. Global news 24 hours a day on air and in Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm looking forward to watching the toboggan racing. Francine, Tom.
Me too. I wasn't thinking about the toboggan racing, but actually it's a very good point. Laura, right there in London. Coming up, Euro area banks are set to reopen the cash taps to investors as the ECB's dividends cap expires. So we'll look at what banks will do next. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open. 41 minutes into the European trading day. You're looking at gains of 0.9% across the European space. Here in the UK, gains of 0.6%. Further down the list, the DAX currently gaining about 71 points. That is the picture across the European equity space. Of course, we had the central bankers coming out around the question of inflation. What stood out for me was that Jay Powell was reassuring us that things will remain transitory, but he said he didn't know for how long or how high, essentially, prices would get. But we heard a similar message from Christine Lagarde as well, the BOJ and the BOE. Interestingly, on the Bank of England, Francine, of course, we had the market's now pricing in 3 rate hikes come 2022, and we've talked about the challenges facing the central bank here.
Yeah, inflation. Inflation is here, certainly in the UK, or at least the market think that inflation is here. Senate Majority Leader Chuck Schumer says lawmakers have reached an agreement to avoid a shutdown of the U.S. government this week, but the debt ceiling issue still looms. Well, for more on all of this, we're joined by Bloomberg's Kathleen Hunter. So, Kathleen, what more can you actually tell us about the deal that's been reached in the Senate?
Well, it sounds like essentially what's going to happen today is previously on Monday, Democrats tried to bring forward a spending bill that would fund the government through December 3rd. Government funding runs out at midnight tonight. That was blocked twice by Republicans because it included a debt limit increase, and Republicans have said unequivocally that they're not going to back a debt limit increase, even though in the past debt limit increases have been done on a bipartisan basis. Republicans have said this time around they're not going to back that as long as Democrats pursue Joe Biden's broader economic agenda, which clearly they're trying to move forward with. And so now what Democrats have done is they've just very simply stripped out the debt limit provision, and they're putting forward a bill that would just fund the government through December 3rd. And it looks like that is going to get bipartisan support in the Senate, be quickly sent over to the House, and likely even get to Joe Biden's desk later today.
Okay, so some quick movement there on the question of extending the ability for the US to borrow money. But what does this mean in terms of, and you touched on this, Biden's longer-term economic agenda and how that is challenged?
Well, the thing is, it kind of removes the simplest part of the equation, which is this government funding question. But this is one of the most complex sort of legislative tangles that I've seen in my time covering Congress. And really what's left on the table are the much more complicated issues of raising the debt ceiling and, as you said, advancing Biden's $4 trillion plus economic agenda. So there really isn't a clear path forward yet on how they're going to raise the debt limit, which is problematic. We've seen markets react to that already. We know from Janet Yellen, the Treasury Secretary, that it looks like October 18th is the deadline to do that. That's less than 3 weeks away. So essentially, stay tuned to see how Democrats are going to proceed with raising the debt ceiling. When it comes to the rest of Biden's economic agenda, the $4 trillion measure that's broken up into 2 bits, the hard infrastructure package and the broader, what started out as $3.5 trillion reconciliation package, when it comes to the infrastructure deal, today is a big day for that as well, because that's going to, as of now, come to a vote on the floor of the House. And it's really bringing to light a clash between progressives and moderates. Progressives are threatening to vote down that part of the agenda, the hard infrastructure part, because there is no agreement yet on moving forward with the rest of the agenda, and that's what they are most interested in. And so this is going to be a vote to watch very, very closely. Republicans have said that Nancy Pelosi, the Speaker, has to get to 218 votes, the votes needed to pass it, that she's going to have to get to 218 votes before they would allow any Republicans to vote for it. And so really everyone in Washington is sort of watching closely to see if Pelosi does go ahead with this vote or if she cancels it today. So that'll be a big thing to watch.
Kathleen, thank you so much. Kathleen Hunter there with the very latest on DC politics. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Citigroup is trying to persuade an appeals court that disgruntled Revlon creditors should return more than $500 million that the bank accidentally sent them last year. Federal judges in Manhattan heard arguments from both sides on whether it should reverse a lower court's surprise decision that they can keep the money. Citigroup said that the decision sent shockwaves through the markets. EV startup Lucid says production of its debut electric sedan is underway, with deliveries to begin at the end of next month. The company will focus initially on a $169,000 limited production Dream Edition of the Air sedan, which can run 520 miles on a single charge.
We raised $4.4 billion with the SPAC merger, including the PIPE. We had a healthy cash balance before that. And that sees us through into a healthy position right through to the end of 2022, the end of next year. Clearly, we're going to have to raise some more money because this is a capital-intensive business.
Walmart is expanding its hiring push with plans to recruit 150,000 store employees in the U.S. America's largest private sector employer says most of the jobs will be permanent and full-time positions, and comes at a time when a tight labor market is already pushing companies to boost wages and benefits. That's the Bloomberg Business Flash. Tom, Francine.
Okay, Laura Wright here in London. Thank you. The ECB says Europe's lenders are, quote, not planning significant catch-up distributions when a cap on dividends and buybacks expires. That is later today. Shareholders could be rewarded with as much as 22 billion euros of excess capital. That's according to a Bloomberg forecast. For more, we're joined by Bloomberg's Lucas Strobel. Lucas, what does the change today mean? What will the impact likely be for shareholders?
Well, unfortunately, there won't be a flurry of dividend announcements just today. What today is a freedom day for Eurozone bank dividends, I suppose. To understand the significance, it's best to go back to July when the Bank of England did a very similar thing. That's when they lifted their guardrails for dividends and buybacks for their large banks. Now, in the weeks that followed, which was also mid-year earnings season, you had interim dividends make a comeback from HSBC, Stanchart, Lloyds, NatWest, and Barclays even threw in buybacks on top. Now, in the Eurozone, most banks pay a dividend once a year, or certainly not as frequently as in the UK. So the real excitement starts in late Jan, early Feb, when banks like Deutsche Bank are expected to announce dividends. For Deutsche, it'll be the first since 2019.
So, Lucas, what else should we be watching out for in the banking space?
Well, there are Eurozone banks that do pay interim dividends. Some of them are expected to announce dividends in the coming weeks. They include Intesa and Sabadell. The Benelux banks also pay multiple dividends a year, and they are expected to be big yielders. So that's one thing to look out for, especially as we move into 3Q earnings season. Also, keep an eye out for commentary on capital return policies, buybacks, and dividend policies by these large banks, because they are flush with cash. They've been holding back cash allotted for dividends from 2019. Cash has been accruing in 2020. They have so much of it, they want to return it to shareholders, and they're going to announce ways to do it.
Okay, Bloomberg's Lucas Strobel, thank you for joining us on the removal of that cap. It's going to happen later today. And as Lucas is saying, January could be the month when these dividends start to get paid in significant order. Coming up, central bankers continue to dismiss inflation concerns, even as commodity prices rise further. We'll discuss next with MLive's Ven Ram. This is Bloomberg.
I think what we've seen during this period of time is that
communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. 52 minutes into the European trading day. We're holding on to gains. A little bit of optimism, actually, of what's going on in the U.S. in terms of politics. The European stock 600 gaining almost 1%. Of course, we look at transitory inflation if market believes, actually, central banks that it will be so. So let's take a look at some of the stories we're following today. Now, from today, European banks can reopen the cash taps to investors. The ECB lifting its cap on dividends and buybacks as the economy rebounds. Then, 10 a.m. UK time, we're expecting the latest announcement on the Eurozone unemployment rate.
Yeah, also today, inflation data on Italy and Germany. That's due out. Then at 1:30 p.m. UK time, we're going to have the latest weekly US jobless figures. Of course, that ties into the thinking around jobs and rising claims, by the way, we've seen for 2 straight weeks. The Fed's bond buying spree is leading to a wide gap between growth expectations and long-dated real rates. This is despite the US being on track to clock the fastest growth since 1984. Our MLive strategist Ben Ram notes that the central bank is currently buying bonds at a pace of $1 million a minute in his latest macro view. He joins us now. Ben Ram, what is the significance of this? Why does this stand out for you? What does it tell us as we lead up to taper?
Morning, Tom. Absolutely. So the Fed's balance sheet has fallen nearly tenfold from the end of 2017 to $8.5 trillion now, which means that the central bank has been ramping up its purchases by about 1 million a minute, as you mentioned. At the end of 2017, before the QE began, the 10-year yield was about 4%. Now we are around 1.5%. At current levels, obviously treasuries are pretty rich. How rich is that precisely? I mean, if you imagine treasuries as a stock, the 10-year is trading around a PE of about 67 times. That's phenomenal. And you've got to ask the question, why are treasuries so rich against a backdrop where the US economy, as you mentioned, Tom, is on track to grow at the fastest pace in decades, not only this year, but also next? So one of the key reasons, in my opinion at least, is the Fed's swollen balance sheet. And the Fed isn't even talking about reducing its balance sheet anytime soon. That's not even on the agenda. Yes, we are going to get a taper, but a taper just means a reduction in the pace of purchases. Mind you, they're still adding to the balance sheet. We are not even in a position to talk about a reduction of the balance sheet. And that's what needs to happen for treasury yields to climb up to anywhere near the levels that prevailed before the financial crisis.
So, Ven, what does it tell us actually about price discovery in bonds?
Well, obviously, price discovery is stifled by by the balance sheet, by the humongous balance sheet, and the Fed is going to continue to purchase bonds, albeit at a slower pace, through the middle of next year. That is why, when the Fed announced that it is ready to start tapering next month, when it announced that last week, the reaction was anemic in the markets. Of course, we got a subsequent reaction in treasuries, but that was more led by the sell-off in gilts and spiraling energy prices. So this stifles price discovery, and it means that we are not going to get treasury yields climb up anywhere vigorously soon.
Ven, thank you so much. Ven Ram there from Bloomberg's MLive team.
Okay, before we let you go, let's just check back in on the market. Some solid gains across the European session, up 0.8% for the Stocks Europe 600. You're seeing gains of 0.7% over in France, the CAC 40. And here in the UK, gains of 0.6%. Your euro dollar currently at 1.16. The US 10-year, the yield just ticking up. It's 1.53. Central bank is coming out trying to assuage those concerns about inflation. Is there a disconnect, though, between that rhetoric and the reality for households? That is it for the European Market Open Surveillance. Early edition is up next. Stay with us. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
There are a lot of value traps populating traditional benchmarks today, and the value traps there are going to be significant downside surprises.
Think of people whose jobs have now been displaced by this big step that business has taken to digitalization, who have no financial assets to begin with, so they didn't benefit from what has happened to asset prices.
You know, we've had so many hacks, terrorist attacks, the Colonial Pipeline incident. It would appear to me that we are extremely vulnerable to having an attack against the payment system of the financial markets.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance, Early Edition on this Thursday, the 30th of September. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Central bank chiefs tried to reassure the markets over inflation, voicing optimism that supply chain hitches will only lift inflation temporarily. Well, Senate Majority Leader Chuck Schumer says a deal has been reached to avoid a U.S. government shutdown this Friday. Key risks to President Biden's economic agenda actually remain. And how artificial intelligence will change the world in the next 2 decades. We'll speak to the AI pioneer and China VC Kai-Fu Lee. Now, first, let's check in on the markets. And actually, it seems like it's a green day. If you look at the European stock 600, getting some 0.8%. We're seeing some similar gains for the DAX, the S&P futures. The point here is that there are concerns about inflation. We didn't have such great data out of China. Actually, some of the worst factory orders since last year, 2020. But overlying all of this uncertainty over inflation, whether it's temporary or not, is also a belief or actually optimism that at least some of the politics in the U.S. is easing up, and we're not going to see that crunch time on October 1st. So let's quickly check on the European maps. There's a couple of stories that we also need to watch out for in terms of inflation and in terms of some of the margins that, for example, you're seeing on some of the retailers. So we've got a nice little lift from H&M. Boohoo, though, on the way down in the retail space. The UK holding up 0.6%. We had 3 energy companies actually going bust because of higher energy prices. So this is probably the one story dominating the FTSE, and then the FTSE maybe in Italy getting some 0.5%. So the jump that we've seen in sovereign bond yields has highlighted concerns among investors about the persistence of inflation. But the Fed Chair Jay Powell and other key leaders from central banking have voiced cautious optimism as they see the effect on inflation from supply chain disruptions proving temporary. They've been speaking at the ECB's Forum on Central Banking.
This inflationary spike will not lead to a new regime of ongoing higher inflation. The current inflation spike is really a consequence of supply constraints meeting very strong demand.
We certainly have no reason to believe that this price increases that we're seeing now will not be largely transitory.
Excluding the temporary factors like this one, the underlying inflation is not so weak as the headline figure.
The preferred tool will always be rates, because we understand the effect. The effect of rates in the monetary transmission mechanism is much better understood. That's not to prejudge what we will decide in November.
Well, we're now joined by Francesco Sandrini, Senior Multi-Asset Strategist at Amundi. Francesco, when you look at some of the things that are supporting equity markets, I don't know whether it's just a belief that margins will be okay and equities keep on rising, or whether there's a firm belief that actually policy will be okay and we're not going to see hikes too soon.
Yeah, that's good morning, Francina. That's a very difficult environment for investors, as you can imagine. We think that there is still a leg up for the equity markets because the growth it's faltering a little, but it's still positive, and the momentum is quite good. The margins of the company, like you have alluded to, are extremely safe because they are quite large in this phase. But clearly, there are the seeds of fragility. The market in this phase is a little crowded out by this persistency of inflation. It's beyond any doubt that central bankers are right in calling the temporal effects of inflation. But the persistency, it's what hurts the financial market in this phase, especially on the margin. So the big point here is the fact that these bottlenecks will not fade away in 1 or 2 months, but they're going to stay for a few quarters more. And the market at some point trades the second derivative of stagflation, that is basically a deceleration on the macroeconomic growth combined with an acceleration of the inflation printings.
But Francesco, we also spoke to Kathy Wood of ARK Investment, and she thinks, the worry is not inflation, it's actually deflation. First, let's have a listen to what she says.
There are a lot of value traps populating traditional benchmarks today, and the value traps there are going to be significant downside surprises because of all of the disruption and disintermediation we see taking place in the world today, thanks to technologically enabled innovation. And so the other this is a combination of, innovation call, but it's also a call on the corporate bond market. Watch out. Watch out.
So, Francesco, what would you be watching out for? Is there a risk that actually we think inflation's coming, central banks say it's temporary, and then we end up with a deflationary environment that is extremely sticky to get out from?
Yeah, Kathy is absolutely right. I think that the future, for a lot of different reasons that would be too long to debate, is largely deflationary in the future, or at least with a quite low inflation printings. The problem today, in my opinion, is the fact that we are living with financial markets, and in particular equity markets, that have become a little addicted. The valuations looks quite stretched according to our indicators. And in this environment, after many years of multiple expansion related to 10 years quantitative easing without interruption or almost without interruption, there is this embedded fragility in the system. And clearly, I think that this is not a question of looking at 3 years, 5 years ahead, but this is a question to looking to 1 year ahead. And the market is certainly set for some form of correction that we believe will not be a definitive correction, but will be a temporary correction that perhaps will be a buy the dip opportunity for many investors.
So, Francesco, do you have a favorite asset class right now? Is there something that looks attractive?
Yeah, I think that in this phase of the cycle, normally transitioning from a huge recovery into a mid-cycle, we need to look at quality. We need to look at visibility of earnings. We need to look at safety of cash flow provision. And in this phase, I think it is extremely important to stay balanced. So this is the phase of the cycle where we would like to have quality sectors, where we would like to have a little exposure to growth as well, that we believe is the theme for the next couple of quarters. But there is a problem. There are things that you have alluded to before, like, for example, the relief of the ban from the European Central Bank on the banks for the dividends. There is this increase of interest rates because of this hawkish wave from central banks in the last announcements. Yeah. There are the conditions for a little upside for the value in this phase that we believe will be temporary. So quality, growth, we prefer US markets to more cyclical markets, but temporarily the situation may be different for a couple of weeks.
And Francesco, what do you do with China right now? So again, many questions on Evergrande, many questions on what they do with some of the policies put in place that may be good in the longer term, for example, on commodities or coal, but they're actually quite concerning right now. So what's your take on China? How do you play it?
We try to have still some commitment on the government bonds, but at the moment we are a little on the sideline on the equity. The reason is exactly what you said. The Common Prosperity Plan sheds some shadow on the kind of capitalism that China may want to fulfill and achieve in the future. So because of that, it's a little of a falling knife. We see that anytime the market looks for a plateau, then there is a second leg down. That was the case for many companies like Tencent the week before. So we prefer to stay at the moment a little out of China, trying to play some index with a lot of cautiousness, like the CSI 300, that are a little more on inshore China equity.
Francesco, thanks so much. Francesco Sandrini there from Amundi stays with us. Coming up, strategists once again say that sterling is behaving like an emerging market currency. We'll get Francesco's outlook on the UK and UK assets amid pressures on the pound. This is Bloomberg.
Blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Hi, Francine. The EU and US are still divided over tariffs on metals, a dispute going back to the Trump era. EU officials told reporters on the sidelines of the US-EU Trade and Technology Council meeting in Pittsburgh the issue was discussed, but a resolution has not been found so far. Trump imposed tariffs on imports of steel and aluminium in 2018. China's factory activity contracted in September for the first time since February 2020, before the pandemic, as a power supply crunch worsened through the month. The official manufacturing PMI number was 49.6. Non-manufacturing activity picked up, though, with a PMI of 53.2, coming in well ahead of estimates. The International Olympic Committee says no international spectators will be allowed at Beijing's 2022 Winter Games. It says tickets will be sold exclusively to spectators residing in China's mainland who meet virus requirements. The IOC also says athletes who are not fully vaccinated will have to quarantine for 21 days upon arrival in Beijing. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thank you so much. Laura Wright here in London. Now, the UK economy grew faster than expected in the second quarter of the year, jumping 5.5%, beating forecast of 4.8%. It comes as the government is due to end its pandemic furlough scheme and other benefits that pumped almost £80 billion into the economy. Let's get back to Francesco Sandrini from Amundi with the very latest. Francesco, more than about furloughs, this is about Brexit. This is a country that has been struggling with, costs, finding drivers. We also have a survey saying that they could lack banks and bankers from outside. Do you see value? Is there anything that you want to be invested in the UK right now?
Yes, but the mist is very high at the moment on UK, because on the equity side, you certainly we have the FTSE 250 and the FTSE 100 that are trading at a discount versus the other European indexes or even worldwide indexes as well. And this is extremely attractive to us. At the same time, I think that is pivotal the role of the Bank of England in this phase, because this hawkish bias that has been displayed a while ago has created a little the point I was alluding to before. So we have a strong acceleration on inflation printings, and we have some marginal slowdown from the real side of the economy, especially looking to the retail and looking to the industrial component because of the increase in the price. Things are at margin slowing down. So the market at some point is extremely questioning whether the Bank of England will increase the interest rates, and this is scaring to some extent investors to take too much into the equity markets. On the pound, the market was extremely long before. It was already discounting this kind of rhetoric, perhaps in terms of dynamics and acceleration of inflation. The fear that interest rates could be risen for the wrong reason now creates the conditions for the sell-off, and also the dollar strengthening.
But so what are you expecting how do you expect this actually to end? So, you know, we also have a couple of authority when it comes to foreign exchange markets saying the pound is actually behaving a bit like an emerging market currency. What will happen in the next 6 to 8 months that will settle it either way?
We think that would be quite premature for the Bank of England to increase interest rates, and perhaps the rhetoric will be a little fine-tuned because the situation is not an easy one in UK. And I would say that a lot of the effects are transitory, but rising interest rates in a phase in which these transitory effects, pressures on natural gas, pressures on bottlenecks, pressures even related to Brexit, related to transports, I think that would be advisable to keep a little more of an easing side. And I think that on this basis, the pound will not appreciate further in the next 3 to 6 months, and will remain perhaps in a channel versus the euro, and perhaps a little weakening versus the US dollar.
So, Francesco, overall, are you expecting a catalyst to actually make the markets correct?
Yes, we expect. It's very curious what's going on, because the correction we saw on Tuesday, it was related a lot to this hawkish wave from central bankers led by the Federal Reserve, of course. And it was curious that looking at the flows was very much driven by risk parity players that had to liquidate a little of the equity because of tolerating losses on the fixed income side. But on the same day, we were looking for positive retail flows. And this tells to me the story that the market, as we see today, is still a buy the dip opportunity for many players. And because of that, we think that any correction will be temporary in the region of 5-6%. We are certainly awaiting a correction in this sense, but not yet the time to call the end of the bullish market.
So, Francesco, are you buying dip or equities across the board, or is there a specific industry or a specific country that you're more interested in?
I think that locally in this phase would be advisable not to be too light in terms of values because of the steepening of the curves and the marginal increase on the 10-year notes. And this is something that will be temporary, but sheds the opportunity to stay investing in the short term, also in financials, for example. I would not touch too much steel sectors that are more cyclical, like the materials, but for sure all the other sectors that are more related to the cyclical and the value are appealing in the short term. From a broader perspective, we think that this is a phase where the natural transition is towards quality, and because of that, US equities is preferable to more cyclical markets like European equities and Japan to some extent. Still light on emerging markets for the reason we discussed before.
Francesco, thank you so much for joining us today. Francesco Sandrini, their senior multi-asset strategist at Amundi. Now, coming up, President Biden pitches his economic agenda to lawmakers at the annual congressional baseball game as the Senate strikes a deal on averting a government shutdown. There's still the debt ceiling to contend with. We'll have plenty more on that next. This is Bloomberg.
didn't want our history to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams. There are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
Who are U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests?
Daniel Ricciardo, Michael Jordan, and then Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Senate Majority Leader Chuck Schumer says lawmakers have reached an agreement to avoid a shutdown of the U.S. government this week. But the debt ceiling issue, of course, still looms large. For more, we're joined by Bloomberg's Kathleen Hunter. Kathleen, thank you for joining us. So what more can you actually tell us about the deal that has been reached in the Senate?
Well, it looks like the Senate's going to vote today essentially on a clean continuing resolution. So that would fund the government through December 3rd. And we would expect that the Senate would pass that, send it over to the House. The House would pass it and perhaps even send it to Joe Biden's desk for signature by the end of the day today. That would avert a government shutdown at midnight, and that certainly takes off the table one of the important things that needed to get done by Congress this week, but it leaves a lot of open questions about how to deal with some of the other elements, most specifically the debt ceiling increase, which had been part of this spending bill, but that Democrats stripped out once Republicans made clear they weren't going to support a government funding measure if it did include the debt ceiling. So it's still an open question what Democrats are now going to do to try to pass a debt ceiling increase. They need to do that by October 18th, according to the Treasury Department. And it's also a bit unclear what the fate of Biden's economic agenda is going to be. As of now, Nancy Pelosi, the House Speaker, is saying that she's going to bring to a vote on today, a vote on the infrastructure, the hard infrastructure portion of Biden's agenda. And it's just unclear right now whether or not she has the votes to pass that in the House.
So, Kat, where does this actually leave Joe Biden's broader economic agenda?
Well, the big question is going to be today whether or not Pelosi is able to pass the first piece of that infrastructure piece that we were just discussing. Progressives have said that they're not going to support it. They're threatening to tank it, essentially, because they want some broader guarantees on the rest of the package, which is the soft infrastructure, the things beyond roads and bridges. And right now, that's very much up in the air because we don't know what a pair of moderate Democratic senators, Joe Manchin and Kristen Sinema, we don't know exactly what they're going to go for in terms of a top line number. They want a smaller package than what has been put out there. And so really right now we're watching those negotiations very closely to see what happens, whether or not there is an agreement on a top line number for the rest of the agenda and what's going to happen today with this vote on the hard infrastructure package in the House.
So, Kat, if you look at the mood music in D.C., it's getting better, but what's the number one thing what does Nancy Pelosi need to do in the next 2 or 3 weeks to make sure that there's actually something also with teeth for COP26?
Well, I think that obviously there is a very small margin that Pelosi is working with in the House. She can only lose 3 Democratic votes, and that means that getting through things like anything to do with what progressives are asking for when it comes to climate measures. In particular, that's going to be quite difficult. Those things tend to be expensive, and they don't necessarily have the same amount of support from these moderates that are making demands in the Senate. And so really the challenge for Pelosi is she has a very big tent. There's a lot of moderate Democrats, there's a lot of progressive Democrats, there's a very wide range of ideological opinions. And in the coming days, what she's going to have to do is what she's been doing basically her whole career, but with a bigger intensity and with a very narrow margin, is trying to balance all of those different demands and find a way through the center that gets her to 218 votes.
Kathleen, thank you so much. Kathleen Hunter there on DC politics. In the meantime, this is what we're looking at in the markets. Now, there is a little bit of a sigh of relief because of DC politics stabilizing somewhat. That's giving a nice little lift to European markets. Futures also on the high. I guess the concerns out there is some of the data, factory orders, for example, in China, and also, some of the things that we see in terms of inflation expectations. For example, many markets here in the UK expecting 3 interest rate hikes in 2022. Coming up, we talk artificial intelligence with Kai-Fu Lee. This is Bloomberg.
Bloomberg surveillance to stay on top of the latest market trends, commodity trends, and fashion trends.
Are you going out for a fitting on a base suit?
I'm going to go and get a base suit. The crowd fund was very profitable.
$100,000.
Came in at about 100K, which is what it would take for me to wear that suit on this network. How do you get that bulky fit? I'll find out. I'll have a chat.
You get bulky,
I get the
John.
bulky one.
You know, I'm channeling the president.
Look at those markets.
Don't taper the pants. They
John,
move you
you
just
look
down
so
6.
good in a base suit.
We're
Keep dreaming.
S&P.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Central bank chiefs tried to reassure the markets over inflation, voicing optimism that supply chain hitches will only lift inflation temporarily. Senate Majority Leader Chuck Schumer says a deal has been reached to avoid a U.S. government shutdown this Friday. Key risks to President Biden's economic agenda remain. And how artificial intelligence will change the world in the next 2 decades. We'll speak to AI pioneer and China VC Kai-Fu Lee very shortly. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance early edition on this Thursday, the 30th of April. Now, there's quite a lot of things going on in the markets. We look at inflation expectations. Of course, we look at some of the retail, the ones that are doing well, the ones that aren't. And then we have an agreement on DC politics. So let's get straight to the markets. Our Danny Berger is here in London. Danny, you're focusing on yields.
I certainly am, and we have some yields moving higher today. We still are looking at an equity market that is gaining in the face of those higher yields, which previously had put a dent in the stock market rally. But we heard from Christine Lagarde and Jay Powell, as you mentioned, saying that inflation was transitory, beating that temporary drum. Well, if equity markets are buying it, bond markets aren't. We're still seeing a sell-off across sovereign yields, be it the U.S., be it Germany. Gilt yields peaking above 1%. They haven't closed above this level since May 2019, so we'll see whether or not they could hold. But it's interesting to look at the drivers of these yields. Let me take you into the charts for this, because on one hand, inflation expectations are picking up pretty dramatically in Europe. So that's this blue line here. This is euro inflation forward five-year swaps versus that of the U.S. In Europe, this metric has hit its highest since 2015. So you have the energy crisis, these things leading to higher inflation. But in the U.S., we've really just been treading water. So in Europe, the story is inflation. That's not the story in the U.S. So what is the story? My last chart for you here is the U.S. 10-year real yield. This has been moving higher. You can see over the past month, we've ticked here above negative 90 basis points. So this is a market that's telling us that the Fed is going to move. They're going to raise rates sooner, and that will keep inflation in check, versus in Europe, there really doesn't seem a mechanism to keep those supply side moving inflationary numbers higher, Francine.
Danny, thank you so much. Dan Berger there with some of the real yields moving. Now, Kai-Fu Lee, a celebrated AI pioneer, former president of Google China, and best-selling author of AI Superpowers, has joined forces with novelist Chen Qufang to imagine how our world will be shaped by artificial intelligence over the next 2 decades. Now, in his new book, AI 2041, 10 Visions for Our Future, he sets out how AI will generate unprecedented wealth, revolutionize medicine and education, and create new forms of communications. He's also a pioneering figure in China's venture capital scene and runs Sinovation Ventures, one of the first Chinese VC firms to have a presence in the U.S. Well, we are delighted to be joined by Kai-Fu Lee right now. First of all, Kai-Fu Lee, congratulations on a book. It's very well written, it's very enjoyable, and you actually break down some of the complicated things about AI and things that everyone can understand. How do you see your AI utopia? How many jobs will be lost? What can machines really replace humans in doing?
Right. Thank you for your kind comments. Artificial intelligence is an amazing omni-use technology that can be used in every industry and is primarily used to do routine things. We usually think of AI as becoming so intelligent over beating people, etc. But actually, it is particularly good at simple routine tasks. So in terms of job replacement, it will replace routine jobs first. So jobs like telemarketing, telesales, some customer service, people who do desk jobs, copy pasting, reimbursement reports, entry-level HR, finance jobs. And it will also take over a lot of the blue-collar jobs, simple assembly line, moving things around, visual inspection, and also some tasks that we do, like driving, will be done by AI. So when you add all that together, probably in 20 years, half of the jobs and tasks that are routine will be taken over by AI, which is a double-edged sword because it creates a lot of wealth, saves a lot of money, frees us from having to do routine jobs, but it will certainly also threaten the people who are doing those jobs at that time.
It's interesting that you decide actually to look at what the world looks like in AI in 20 years. Why do we overestimate how much the pace of change in technology happens in 5 years and underestimate the pace over a 20-year period?
I think we, as technologists, sometimes just get too optimistic and think that when I see something work in the laboratory, it'll change the world immediately. I have been a researcher in AI for almost 40 years, and I've made that mistake many times. But if you look at more of a 20-year horizon, our lives truly are completely disrupted. If you now think back 20 years ago, what was the internet like? what did we use it for versus all the things we can do with it, it's been dramatically changed. And I think if we look forward, even more things are likely to change because the pace of improvements are very rapid. If you think about the AI advancements, pretty much all the advancements that AI beating the world's champion in Go and chess and able to diagnose cancer for certain types of cancer better than doctors, able to fold protein better than top scientists. All these things happened in the last 5 years. So I think going forward, that accelerated pace of change and given a 20-year time horizon, we will be living in a world that's basically unimaginable today, almost like science fiction.
So, Kai-Fu, if we look at this, AI supremacy and this fight that has been ongoing for over a decade between the U.S. and China, it's unclear at the moment what the final end game of China is with a lot of the crackdown. But is there still a big chance that actually, China will dominate in the space for the future and actually will take away a lot of the resources from Silicon Valley and the rest of the West?
No, I never saw this as a zero-sum game. When I wrote my last book, AI Superpowers, what I predicted was that China would become very strong in AI, comparable with the US, but each with strengths in different areas. And I think we are now seeing that coming to fruition, and I don't think that's going to change. For example, today we see US continuing to lead the world in enterprise AI, basically on white-collar type of work, enhancement and replacement. US is well ahead with technologies like robotic process automation that is, in fact, replacing the white-collar jobs we talk about. And then with COVID causing jobs to be digitized, once it's digitized, there's data, and once there's data, AI can work. But on China's side, it's very different. China's core foundation of the economy is manufacturing. So we see a lot more robotics going into manufacturing, autonomous forklifts, smart arms, visual inspection, autonomous vehicles. These are very rapidly accelerating in China, probably in most cases leading the US. So I think each country will do what it's good at and will lead the world. And it's not a zero-sum game. And I think the two countries will continue to lead the future of AI.
But Kai-Fu, if as a pioneering technologist, you need data to process to make sure that your findings are right. And this is a huge advantage for China.
Well, yes, China has a lot of people, and the Chinese people use mobile phones a lot more than Americans. So there's more data feeding into that process, as well as the super apps. I spend 80% of my time in one app in China. So all that data goes into Tencent, and they can train phenomenal AI based on that. But as you said earlier, Chinese government is mindful about internet companies with all the data, will they get too strong? So the same way EU and the US have regulated the American giants, I think China will also regulate the Chinese internet giants.
So what does that mean actually for Chinese tech entrepreneurs? Will they be much more cautious? Will it be much more difficult to IPO in the future?
I think most of the concerns are about large internet companies that have great products, brand, users, loyalty, now data and AI to enhance their power. So all of their power is being checked in EU, US, and China. I think that is a one-off thing. Chinese government is very much pro-tech. Well, but the tech here, don't confuse that with Google, Alibaba being tech. Yes, they are, but they also possess the role of a large internet company that's being checked. So the AI startups in China are very much the most important, I think, the crown jewel for China, and they're likely to be listed in the next year. If you look at the AI companies in China, I think we'll probably see about 12 or 15 IPOs in the next 12 months or so. And I believe these will be very successful IPOs. These are hardcore, pure AI companies that are building AI technologies and using them to dramatically improve traditional businesses, banks, insurance companies, manufacturing. They're building drones and robots that are changing, people's lives. And I think this AI sector, if you want to call it as a sector, is both Chinese and American entrepreneurial economy. In China, these, I think, will be among the darlings for investment.
So give me a sense, first of all, these would be companies that IPO locally, I guess, because it's so much more difficult to IPO internationally, given what the Chinese regulators have so far said. And how do the Chinese regulators view these AI companies differently? So is it because it has to be beneficial to some of the other industries, or some of the nuances that you're pointing to are extremely helpful for investors?
Okay, well, the Chinese government is actually very, very pro-tech. I think the reason is very simple. Because of the geopolitical issues, China feels a strong need to have a technological self-sufficiency. So that is why there are incentives and all the ways to help very smart entrepreneurs, whether they're in AI, life sciences, or semiconductor, probably the three big sectors the government is very favorable towards. So, I think there are not currently a lot of companies in these three sectors already publicly listed. But in the next few years, there will be. And I would forecast that, if people who are watching the show believe the Chinese government wants to make a say on favoring some industries and not others, then these are definitely going to be favored, and they will make good investment targets because they will be able to build products that can enjoy not only in the China market, but also Belt and Road countries and potentially internationally. So I think the key challenge, I think, for a lot of people who watch this is when they see China regulating tech, they assume this is negative for all. It's in fact very, very positive for true hard science tech companies, where the regulation target are the large internet companies who use the power of their products and data that can cause problems for fair competition. Those are the ones being targeted. Yeah, I think that the titles can be misleading.
How big would these companies actually be? And I know you don't believe in a zero-sum game between China and the U.S., but actually, if you have a big Chinese AI company, does the U.S. feel threatened? I mean, can you really carve out a future where each part of the world has their specialty on AI, or at some point will they have to go front to front?
Yeah, the AI companies I'm talking about, the 12 or 15 that will go public, are probably valued between $3 billion and $25 billion US. So these are sizable companies that are bona fide AI companies. And there will be a whole new set of life science companies, drug discovery companies, and semiconductors companies in that range of valuation. And then I think we're going to see this as an emergent China pure tech play that will be, I think, quite interesting and profitable. And I currently, if you ask me today, I would say that it's likely that the Chinese AI companies will see China as the primary market. The US AI companies will probably not be able to get into China, and Chinese AI companies probably won't be able to get into the US. This is not necessarily my preferred situation, but the geopolitics is such that Chinese AI companies will sell to China, American AI companies will sell to the US, and they'll both compete in other parts of the world, but US will have some advantages in Europe, Canada, Japan, Australia, and so on, and China may have some advantages in parts of Southeast Asia, maybe Africa, maybe other parts of the world. So yes, they will compete, but the fact remains that China and US are by far the largest market, and they will be unchallenged by the other country.
Kai-Fu Lee, thank you so much. AI pioneer, author, venture capitalist, and former Google China president, with this wonderful book, entertaining but also educational. His new book, AI 2041, 10 Visions for Our Future, actually out now. Now, coming up, H&M reinstates its dividend as earnings beat estimates. We're speaking with the chief financial officer, actually, of the Swedish retailer next. Also, we're getting an update on China with Evergrande paying its first 10% of wealth management products due in September. So I think there's a bit of movement on the Evergrande side. We'll also have a full roundup on China. This is Bloomberg.
如果佢唔係屬於呢個風險嘅地區咧，就全部由聽日開始咧可以恢復翻回港嘅安排啦。呢個計劃咧就將喺9月15日咧就正式推出，名額咧係深圳灣口岸同埋港珠澳大橋香港口岸每個口岸每日各1000人，咁即係話每天咧係合共有2000名非香港居民可以通過來港易咧係豁免檢疫咧係抵達香港。
From New York City,
we're in London, in Sydney,
in San Francisco,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. So we're just getting some breaking news out of the Sarkozy verdict. The former French president's facing a potential prison term in the verdict that just came out minutes ago. So let me see exactly what we have there. And I do believe he's convicted. Mr. Sarkozy convicted of breaking campaign financing rules. We understand that the judge, I think, is still reading the rest of the sentence. So it's unclear whether we'll have a prison sentence, but this certainly was what we're looking at, whether the former French president, Nicolas Sarkozy, will face a potential prison term in a verdict that just came out saying that he has been convicted of breaking campaign finance rules. Now, H&M reinstated its dividend as the company's prospects improve. The Swedish clothing retailer said pre-tax profit more than doubled in the 3 months through to August. H&M also warning that the global supply chain disruption has been hitting sales. Well, we're joined now by H&M Group Chief Financial Officer. He's Adam Carlson. Adam, as always, thank you so much for coming on. First of all, congratulations on a good set of results. You're going back to some of the old school things that we used to do in 2019. What are your main concerns going forward? How tight are the supply chains, and how much potential headwind will there be?
Well, good morning, and thank you for having me. I think, as you said, and we are very happy with the performance of the third quarter. It's a sign of our ability to navigate through uncertain times, and I think that we bring with us. Obviously, COVID is somewhat still affecting the whole world and also supply chains around the world. And we've been facing some delays during the summer, but that we're now getting phased out throughout the start of the autumn here. So we look at positively into the autumn.
You ship a lot of clothes from Asia. Are there any price increases or capacity constraints? And how are you looking at the winter months?
Obviously, we are also part of as I mentioned, a global supply chain, and we are dependent on our partners around the world. We have, throughout this past 18 months, strengthened those partnerships, so we believe that we can work as a very strong business partners and find ways to mitigate some of these challenges. So we're looking positively towards the autumn and into the winter.
How's China doing? I know China sales were down some 23%, maybe because of some of the social media backlash. Are you back on track?
Well, we don't comment on China specifically. It's a complex situation that we follow closely, but as previously mentioned, we don't comment specifically on China.
Okay, can you give us some of the, if you look at some of the product delays, have they affected certain countries in the summer more than others? And actually, what are some of the steps that you took to try and mitigate that?
There are some combinations of leaving ports and receiving ports that are more hit than others. Some of the ports in the U.S. are more heavily congested, for example, so that we're then mitigating by shipping the goods slightly earlier. So we have a proactive plan that we put in place over the summer that we're now executing on.
Can you give us any idea of some of the openings of stores or some of the closing stores that you'll see in 2022? What does the next 12 months look like?
We still see the store estate as a huge asset for us, and that I think is just once again confirmed by how the recovery is now coming into place. So we have celebrated opening in some new markets, for example, Panama here just recently, and we're looking into a couple of new markets also going ahead.
So what does that mean for, the fact that you reinstated a dividend and you had some pretty good earnings? Do you think you're out of crisis mode? What does it mean for the future?
It is a sign that we maneuvered these uncertain times really, really well, that we are agile, we're able to take the needed actions. But of course, we're also humble looking ahead now. So it's not fair to say that we're out of the crisis as the world is still affected by the pandemic, but it's a sign that we managed to navigate in a good way.
What's your biggest priority or your biggest concern over the next 12 months? I know you don't want to comment about China. Is that because it is China that you need to try and figure out now?
No, but we want to go back to normality in all aspects, obviously, that we can welcome our customers in our stores. So that's a big priority for us. And also then evolving the whole customer experience. We've taken huge steps before, and now we're continuing on that journey. Integrating the channels, working with the supply chain, and ensuring that the customer gets the best customer experience all around the world.
What does a new normal look like? Will the pandemic actually change the way we shop forever?
I think we have welcomed a lot of new customers, and also customers have found ways to shop with us in new ways. So I think the new normal will be a combination of the good things that we saw in the past and some new findings, also when it comes to how customer behaves and how we use the digital tools, all the way from shopping to how we meet and integrate. So I think we have a strong base to stand on and some strong learnings from the last year and a half.
All right, thanks so much. Adam Carlson there, the Chief Financial Officer of H&M Group, with some of the earnings and reinstating dividends this morning. Now, we're looking at what's happening in France at the moment. Just moments ago, we had the verdict on Nicolas Sarkozy. It's taken quite some time, actually, for the verdict to come out. The French ex-president, Nicolas Sarkozy, has been found guilty of illegal campaign financing for his unsuccessful 2012 bid. So we'll have plenty more on that. Unclear at the moment for me, but maybe producers have a little bit more of an idea whether he will go to jail or not. This was talking about a prison sentence. I don't know whether there's a verdict on that or whether we just need to wait as the judge continues reading. I understand in France what will be the fate of Mr. Sarkozy. The judge says that Nicolas Sarkozy was warned of overspending. He says he deliberately broke campaign financing limits, and therefore he is now convicted of breaking some of these campaign financing rules. Now, to the markets. A lot going on in the markets. This is as stocks are extending gains. We did have quite a volatile quarter. It's nearing the end. Tomorrow, a reminder, it's not only Friday, but it's also October 1st. Now, some of these global global stocks are rebounding. The positive news out there is that the debt ceiling deal in Washington, but also central bank assurances about transitory inflation, boosted optimism about the economic recovery. What I would be cautious about is some of the data coming out of China. Now, Asian stocks actually rate losses. We did see some gains in China before a week-long holiday, and yet the data wasn't as good as expected, certainly when it came to factory orders. So global stocks poised to end the quarter with a small loss after a 5-quarter rally. Investors again bracing for the Fed to wind down its stimulus. They also remain concerned about slowing growth. They remain concerned about elevated inflation. They worry about supply chain bottlenecks, an energy crunch, and of course regulatory risks emanating from China. In fact, a majority of participants in a Citigroup survey say that a 20% pullback in stocks is more likely than a 20% rally. Bloomberg Surveillance Early Edition continues in the next hour. Danny Berger will be joining me here in London. Kelly Lyons will be in New York. We'll have all of the market moves. We'll also bring you some insight from some of the bankers we spoke to yesterday. Dip buying continuing this Thursday. Miners pacing the gains. Iron ore climbing. I'm looking at technology stocks battered earlier this week, also extending the rebound. Then we look at Senate Majority Leader Chuck Schumer saying that lawmakers has reached an agreement to avoid a government shutdown. This is Bloomberg.
Electricity subscriptions, it's a part of this new business area that we have called the clean energy services. So the purpose with this new business area is to contribute and to create this biggest movement in the world for renewable energy. We will add even more products. We have solar panels that we sell, and now we have the electricity subscription. So it really fits that ambition that we have to, within the frame of life at home, the most important place in the world, we can add more value to our customers to live more sustainably. And this is a big part of the climate positive strategy that IKEA has for 2030, that we will remove and reduce climate emissions more than we emit in our entire value chain.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We realise that there's a lot going on to digest. It's very political, this whole debt process, the whole infrastructure bill, and indeed everything that's happening at the central bank in the US, very political process behind that.
The Democrats are trying to thread a very, very thin needle hole with getting infrastructure through, the human infrastructure, and raising the debt ceiling. Everything has to go according to plan, and it's going to be pretty messy.
Biden's overwhelming priority, and everyone is rowing in the same direction on this, is ensure that the progressives, as well as Manchin and Sinema in Senate, get together to get these trillions of dollars done.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong this Thursday, September 30th. Our top stories today. Last-minute maneuvering on Capitol Hill. Congress is set to avert a government shutdown with just hours to spare. But Democrats are still deadlocked over President Biden's economic agenda. Fallout from Evergrande debt crisis. China tells bankers they need to support the rapidly cooling housing market and help mortgage holders. And what comes next? Investors add up their wins and losses from the third quarter. We'll look at the risks to the global economy and what it faces in the final 3 months of the year. Well, good morning, everyone. I'm Francine Lacqua with Danny Berger in London, Keely Lines in New York. Matt Miller off this week. Keely, the markets, of course, they're worried about energy prices. They're worried about supply concerns. But because we had the government in the U.S. averting government shutdown, they're rising today.
Yeah, that may be aiding risk appetite, certainly when it comes to U.S. futures, and we're seeing some positivity in Europe as well. But Asia ending the third quarter a bit mixed. You did have stocks down in Hong Kong and in Japan. China, though, up 0.7%. Of course, it is the last day of trading in China before a week-long holiday, and there's many things that the market had to digest. On the one hand, you had manufacturing PMIs for the month of September in contraction territory for the first time since February of 2020. It shows that power crunch that you were alluding to, Francine, is biting manufacturing activity. Of course, the other thing China has to worry about is the ongoing crisis with Evergrande and the property sector. We got news overnight that the PBOC has asked 24 banks to help shore up the housing market. That lifted property stocks broadly. Evergrande, though, did fall today, down about 4%. Two holders of its dollar bonds that had a coupon payment due yesterday said they have not received anything. Elsewhere, the Chinese yuan is a big outperformer in Asian FX today, stronger against the dollar by about 0.2%. And iron ore up 3% in Singapore, maybe traders trying to get a little buying in ahead of the holiday. Now, as for the picture here in the U.S., we did see dip buying yesterday, but it really wasn't very strong. And actually, we saw selling into the close, the S&P 500 only ending Wednesday 0.2% higher. So we will see if the gains we are seeing early on today can indeed hold. Right now, S&P 500 futures up about 0.7%. The bond market steady as she goes. We're essentially unchanged on the 10-year yield. 152 is where we sit. We are seeing a weaker dollar today, coming off of its strongest level since November of 2020. That affecting dynamics really across asset classes. And then I would point to crude trying to rebound after 2 days of losses. Danny, WTI back north of $75 a barrel.
Of course, within all of this, we have to keep in mind it's not just month end, it's quarter end too. So we might see some window dressing that makes assets move and behave how we might not expect them to. Well, in the UK and rest of Europe, we are taking a bite out of that month to date loss. It is very tepid gains, I should say. And as we've gotten through the session, we're now about 2 hours into the cash equity trading session. These gains have started to peter out. We see things like autos underperforming. So the DAX only up 0.2% versus, for example, the CAC 40, which is up 0.6%. UK outperforming. A lot of that is the material stocks doing well with iron ore on a tear. That's related to China mills stocking up before the holiday. So some uneven performance, but generally green across the screen. So here's where your benchmark index is, up 0.7%. But really the macro picture here when it comes to cable and the UK 10-year yield has to do with this concern over stagflation. Is the energy crunch going to mean that inflation goes higher, but central banks can't handle it? Well, that allowed cable to break below 135 yesterday. We're still below that level, just up 8 basis points. That mostly has to do with a weaker dollar more than anything. And your UK 10-year yield up above 1% yet again. It hasn't closed at this level. Last time it did was May 2019. Boohoo really does factor into all of this. It is an online fast fashion clothing retailer. They had done well during the pandemic, but their shares are falling more than 10% this morning. They had earnings and cut their sales outlook, and they're forecasting supply chain issues are weighing on us. We can't get the goods we have to meet demand. It really is this bullwhip of demand that a slight change in how much consumers want means supply chain issues. Francine, this is also an issue for H&M as well, and I know you spoke to the CFO this morning.
Yeah, and look, a lot of concerns that actually the market is also reflecting for the chief executives. It's supply chains, it's energy crunch, it's of course regulatory risks also emanating from China. Now look at what else is ahead today in the U.S. The Senate votes on an infrastructure package that underscores deep divisions amongst Democrats. The UK furlough scheme ends, which has been supporting people who would otherwise have lost their jobs during the pandemic. The ECB's recommendations to cap dividends and buybacks are due to expire, which could lead to a surge in bank dividends this year. At 10 a.m. New York time, also the House Financial Services Committee holds a hearing on the Fed and Treasury's pandemic response. The Fed Chair Jay Powell and Secretary Janet Yellen are expected to testify. Also, transport and health ministers of G7 countries are set to meet virtually to discuss ways to restart international travel, while the meeting is being organized by the UK, which holds the presidency of the G7 nations this year. Now, onto one of our top stories, China urging bankers to help local governments stabilize a rapidly cooling housing market and ease mortgages for some home buyers. Now, this is just another signal that authorities are worried about a fallout from the debt crisis at Evergrande. Let's get more with our China expert, Tom McKenzie. So, Tom, it seems that actually we're getting a little bit more news on really how critical the Chinese authorities want to save Evergrande.
Yeah, the policy response is becoming more sharply in focus. There's still a long way to go. It's taken a lot of time. It's taken a lot of pain as well. But what we do have is this meeting then by the central bank governor, Yi Gang, along with securities officials from the housing ministry saying, look, sign off on mortgages from mortgage borrowers who are good to go, and also make sure that property developments that are already under construction, that they continue to lend to those developers where they are building out projects, because we know that 1.6 million households or individuals in China have put down deposits on houses that have yet to be built. So it follows on from the local government yesterday stepping in to buy that stake in a bank that Evergrande owns. So shoring up the banking system, but ensuring that the developers who are working to build out their properties are getting the credit that they need. By the way, Citigroup pointing out that 40% of China's bank assets are in some way linked to the property sector.
And then there's the macro issue of the data we got this morning. China PMI showing the first manufacturing contraction since February of 2020. I was surprised though, stocks didn't move much, bonds didn't move much. Why the muted reaction to this?
Good news is bad news. I think probably the assumption that the PBOC is going to have to do more than just get officials in one room and get them to encourage to open up the spigots on credit, at least marginally. It's about the triple R and whether or not, and other policy responses. Triple R seems to be the consensus view. You're going to get another cut to those reserves, is the view from some economists, because the economic pain is very acute now. And you're absolutely right. We saw that in this manufacturing data for the first time contracting, at least since the pandemic. Services was still in expansionary territory, but there's a long way to go there. The restrictions around COVID has held spending back. So you don't have the consumer back in full force. You don't have manufacturing back in full force. And of course, the real estate sector under pressure as well. That's leading to many to downgrade their views on China's economy.
The consistent assumption that easier policy will come to the rescue. Thank you so much to Bloomberg's Tom McKenzie. Now let's head over to Washington. Congress and President Biden are set to avoid a disruptive shutdown of the federal government with just hours to spare. It's the eve of the new fiscal year, and the Senate and House are expected to vote to extend government funding until December 3rd. Jack Fitzpatrick, Bloomberg government reporter, joins us now from Washington. So Jack, maybe we're close to a victory on one battle, but there are other battles ongoing, including the vote on the bipartisan infrastructure package in the House today. The question is, are the progressives going to tank it?
The progressives are going to try to tank it. The outstanding question on the infrastructure vote is, could enough moderate Republicans join and support this. We don't have an exact whip count, but it looks like things are probably leaning away from a clear ability to actually pass that infrastructure bill, because there are a number of progressives who are still trying to block it. And the only thing that was going to get them on board if there was significant progress made on the $3.5 trillion reconciliation bill, which has not happened. So that two-track process is still an issue, and it's still not going very well because of how slow things have moved with the other larger bill that Democrats want to pass.
So, Jack, what's the next step?
The next step on reconciliation and infrastructure is to try to get the moderates, Senators Manchin and Sinema, to try to give them a top line and say, if not $3.5 trillion, what exactly do you want? The problem with that is Senator Manchin and some House moderates have said, really, we just want to slow this down. They haven't been specific on exactly what they want, and they want the process to not go absolutely pedal to the metal right now. So the timing of trying to link up the infrastructure bill and the reconciliation bill might not be possible. We'll see if it's possible to actually pass the infrastructure bill today. That's not absolutely ruled out, depending on Republican votes. But things are really gummed up right now because Senator Manchin and Sinema in particular have not been really specific about what would get them on board with the broader legislative agenda.
Jack, thank you so much. Jack Fitzpatrick there of Bloomberg U.S. government. Now, the UK economy emerged from the winter lockdown stronger than expected. More recent data, though, suggests that the pace of the recovery is actually fading. Let's get more now with our Bloomberg UK economics reporter, Lizzie Birding. Lizzie, first of all, energy out of control, but actually in the past, the economy was better than expected.
Yes, we had the second quarter GDP print this morning. As you can see, the economy grew 5.5%, more than the 4.8% that was previously expected. But the recovery is running into trouble because of the material shortages, as you say, because of the rising COVID cases. So the Bank of England last week downgraded its forecast for the third quarter to 2.1%. And economists say that its forecast for the fourth quarter is looking increasingly optimistic. At the same time, traders are now pricing for 3 rate hikes in 2022. So I don't envy the Governor Andrew Bailey's job of having to keep a lid on inflation while not choking off the recovery.
Certainly a very careful balance. And at the same time, Lizzie, today we're losing the support of the UK furlough. What will be the impact of removing that support?
Well, for the million or so people who were the last left on furlough, the future really is uncertain. We've had warnings for months of a spike in unemployment, but the latest jobs data don't reflect that. The Bank of England doesn't expect that. The hardest hit are likely to be older workers on lower incomes who will be pushed into early retirement. But don't forget, it's not just the furlough scheme that's ending, it's also the £20 a week uplift in universal credit. 6 million households, 6 million individuals were benefiting from that. So ending the two measures at the same time piles pressure on household finances, and it means that the supply disruptions we've been seeing could combine with weaker consumer confidence, lower household spending, and stick the economy into reverse.
The normalization of pandemic policies is definitely going to be difficult. Thank you so much to Bloomberg's Lizzie Birding. Let's get back to the markets now and take a look at some stocks moving in pre-market trading here in the U.S. I have to begin with Virgin Galactic, of course, Richard Branson's space exploration company. If you remember, the FAA grounded Virgin earlier this month because it was investigating a deviation from its flight path from a flight back in July. The FAA last night saying, though, that investigation has concluded. Virgin can fly again, and as a result, those shares are flying in pre-market trading up about 10%. Another mover to the upside is Lordstown Motors, of course, the electric truck startup. It is selling its factory in Ohio to Foxconn, which is a manufacturer for Apple. That could help the company raise some cash, which it basically really needs. So that stock is up 6% before the bell. And another big mover to the upside is Perrigo, which makes over-the-counter drugs, self-care types of products. It has settled a tax dispute with the Irish government. And an analyst over at Jefferies says that resolution actually is very favorable. That stock is up about 14% before the bell, Francine.
Kelly, thanks so much with some of the pre-movers there. Now, joining us shortly, John Hardy, Saxo Bank Head of FX Strategy. And then later on the DC drama, we'll speak with Julie Norman of University College London. We have you covered for any dollar move. We look at sterling, and of course, we look at DC. This is Bloomberg.
What have we learned from this evergreen crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we see many events, right? Maybe in the fintech sector and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike because of the sentiment. The evergreen is hurting the sentiment and people don't want to buy. And other developer because they want to get cash.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Francine Lacqua in London alongside Kaylee Lyons in New York. I want to kick us off with a market conundrum, just a quick FX 101 lesson. Typically in developed economies, when yields move higher, so too does the strength of that country's currency. But something is awry when it comes to these UK markets, and I want to welcome our radio listeners as well. I have a chart next to me, and I will explain to our radio listeners what the chart is. I have two lines on here. One is cable for our TV viewers, that's in the white. The other line I have on here are gilt yields, specifically the benchmark 10-year yield. And you can see this relationship typically does hold up, and it has for most of the past year. However, over the past few weeks, it is a stark divergence. We've had cable decline, falling below 1.35 for the first time since January. And at the same time, just today, we had that 10-year yield tick up above 1%. So this is a broken correlation. And it's just happened recently as we have these energy issues waffling through the market. We had Adam Cole over at RBC saying that now cable is trading more like an emerging market currency. So what is all behind this? Let's try to get some answers. Let's go to our Noor Al-Ali, our Bloomberg M Live editor, who joins us now. Noor, thanks so much for joining us. So what do you attribute this divergence to?
Well, realistically, when it comes to the pound right now, it's a story of two folds. There's the local end of it, what's happening in the economic growth in the country, and also the dollar strength there, really pushing the G10 majors down and also emerging markets.
So you could argue, Nora, that actually BOE is the most exciting central bank out there, with money markets also expecting 3 hikes in 2022.
Yeah, I mean, there's that. But also, Andrew Bailey came out yesterday and said, well, listen, let's not be too excited about what we were excited about 2 weeks ago. Let's just, slow down that growth there. Because the GDP data that came out today for the second quarter is really reminiscent of the Euro 2020. So even though it was revised upwards, it's coming home chanting right behind you. So what I'm really interested in seeing is whether or not the economy can rebound after the furlough scheme ends. And that's happening today. So let's see what goes on in the quarter ahead.
Nor, speaking of the economic data, we got some out of China overnight, a contraction for manufacturing PMIs for the first time since February of 2020. Why is that not sending more of a warning signal to risk assets?
Well, currently, anytime an economy would contract, the size of China is very concerning, especially when it comes to commodities. That, for me, is a signal that they may struggle because that means imports may decrease and what have you. But you still have the energy crunch out of Europe and Asia as well. And I don't think it has extended as far as much to the U.S. because you've got LNG supplies there. But that energy crunch is a much greater story right now. It's a lot more temporary because we're expecting that strength to kind of decrease as the winter goes through. But so far right now, we've got the energy crunch really supporting crude prices through this.
So if it isn't really being felt in the U.S., is it fair to say that the markets view this as the Fed being able able to control inflation, while in the rest of the world, UK, ECB, they can't?
Well, no, look, I never want to say the ECB can't do something on record.
Very diplomatic.
But here's the thing. You are feeling that stretch of inflation a lot stronger in the euro area. So you've got break-evens out of France and Germany really not skyrocketing, but increasing. They have come off a little bit today out of the German 10-year break-even rates. But realistically, what we've got here is an ECB, a bank that says, we're not worried about that inflation spike, whereas the Fed has given us that hawkish tilt. Obviously, you've got the non-farm payrolls coming up next week, and that's going to give us the biggest and truest test of whether or not the U.S. economy and employment has rebounded.
We have to get you back. We haven't even talked about deflation, nor what's going on, nor our either from our MLive team. Now, for more market analysis, check out MLIV Go on your terminal, one of the smartest voices around on inflation. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This This is Bloomberg Surveillance, early edition of Francine Lacqua with Danny Berger in London, Kaylee Lyons in New York. Now let's get straight to the Bloomberg First Word News. And the Federal Reserve Chair, Jay Powell, and his international counterparts have renewed their assurances that a surge in inflation is temporary. Now, at a virtual panel hosted by the European Central Bank, Powell said the spike is really a consequence of supply constraints meeting very strong demand. Well, he said that's all associated with the reopening of the economy. The G7 economy is also looking for ways to restart international travel. Well, Bloomberg has learned that transport and health ministers will meet virtually today. The meeting is aimed at moving closer to a consensus on how to ease border restrictions. While some countries, including members of the EU, have used so-called vaccine passports, others, like the US, have held back for reasons ranging from politics to privacy. And in France, former President Nicolas Sarkozy has been convicted of deliberately overspending in his failed 2012 re-election campaign. Now, criminal courts found that Sarkozy spent roughly $50 million, about twice as much as was legally allowed. Prosecutors have asked for a 6-month sentence. Earlier this year, Sarkozy was convicted of corruption. So we'll have plenty more, of course, on that. And the UK is suffering a shortage of truck drivers. Now, lobbyists in post-Brexit Britain warn there may not be enough bankers. International staff make up a fifth of the 1.1 million people working in UK financial services. According to lobbyists and consultants, Brexit is making it harder and more expensive to hire foreign staff. I don't know about you, Danny, but actually I hear so many people that went back to Europe, and it's builders. There's definitely going to be a supply crunch on many more industries than just energy.
And I'm not sure how this goes down in the Lacqua household, but of course, Paris is becoming kind of the new beacon for investment banks. Everyone from JP Morgan to Goldman Sachs, Morgan Stanley saying, hey, if you're going to come work for us in Europe, don't go to the UK, come to Paris.
Yeah, and then other banks choosing Frankfurt, which may be a little bit of a tougher sell. Maybe Kelly goes to Frankfurt because you have more regulation. I mean, it's one of the fun dinner party questions, Kaylee, here in the UK. So if you had to go anywhere because, you lose the clearinghouse in London, where'd you go?
I think I'd pick Paris. Just better food, I feel like.
Kaylee, Francine and I are in London. We're going to have to revisit this answer.
Right? Isn't that the point of the question?
Yeah, so maybe Madrid.
Okay, fair.
There's been a big push to try and get bankers to Madrid. Up next, John Hardy, head of FX strategy at Saxo Bank. This is Bloomberg.
Boosters work, and they will definitely help. The boosters, both the Moderna and the Pfizer booster, take antibodies back up to at least where they were, and probably twice or 4 times where they were at the peak. It's definitely teaching your immune system to recognize Delta better. The antibodies that people are making after a booster, they are better antibodies. And they're also probably then better antibodies at recognizing other variants in the future. If you get infected once, your immune system says, all right, here's how much I want to set aside of memory, right, to not get that again. You get infected twice, your immune system says, well, that didn't work, right? It should probably up that some. You get infected 3 times, your immune system is like, all right, this is a problem. It's really worth not getting sick anymore. And so the vaccines are essentially that, right? And if the immune memory was pretty good after the second one, what's probably probably going to happen after the third one is that it's going to be more stable. Even if the peak is the same, you're going to keep more of it for a longer period of time. It's a race, right? It's a race between the virus and your immune system.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lack with Danny Berger in London, Kelly Lyons in New York. Matt Miller off this week. Danny, we look at the markets. It's the end of the quarter. We look at some of the worries, supply crunch, energy concerns, of course, inflation may be coming back. But we have a bit of positive news out of D.C.
Yeah, we certainly do. That's helping risk sentiment here that at least we're not heading towards a shutdown. Of course, the debt ceiling is still an outstanding issue. This is something that traders and investors typically don't care about because it has a way of sorting itself out. So that remains on the back burner. But for now, it's just the unknown of the fourth quarter, bringing a lot of uncertainty into this market. Unknown about inflation. Could it be stagflation? And now, Francine, calls are just piling up across the board that we could see a correction or at worst a 20% drop in these equity markets. At least that's what the latest Citi survey of their clients says.
Yeah, and we look at yields as well. Kaylee, how's it all playing out in today's markets?
Well, it doesn't look like a correction is on deck today, Francine and Danny. I would note today is day 230 trading days in which the S&P 500 hasn't seen a 5% pullback. Now here in Europe, or out there in Europe, where you guys are, I should say, we are seeing gains, though the stock 600 is off session highs. It's only up about 0.5% right now. It's really basic resources and energy leading the way in the session. Here in the U.S., S&P 500 futures are in positive territory to the tune of about 0.6%. The question is, come the open and through the trading day, will those gains hold? Because they've had difficulty doing that as of late. We go nowhere right now on the 10-year Treasury yield, literally unchanged, just shy of 1.52%, but a little bit more action happening in Bitcoin. Just keep an eye on it, up 5% today, back north of $43,000. And with that move in Bitcoin, we are seeing some subsequent moves in Bitcoin-related equities. Marathon Digital, Riot Blockchain, MicroStrategy, Coinbase Global, all higher to the tune of 2 to 4%, Danny.
Well, Kaylee, I want to talk about King Dollar. It might be a little bit weaker today, but it still has its crown. I also want to welcome our radio listeners as well. I have a chart up that I'll explain to you. Two lines on the graph. You have the Bloomberg dollar spot, and you have that dollar spot's 1-year risk reversal, essentially where the wind is blowing in options in terms of bullish or bearish. Now, you can see this continued uptrend for the dollar over the past month. Again, for our listeners, it has been pretty strong as it shows on this chart. And the momentum doesn't look like it's going anywhere for the dollar. And that can be seen or really enforced through what the options market is doing. The risk reversals are also very elevated. At the moment, they are at 70 basis points. It is basically more demand for topside options, and the most bullish these options, Francine, have been since June of 2020.
Yeah, if you look at some of the rise, of course, in the dollar, between June and actually the 3rd of September, it was 4.3%. And some people also say that that could point to cheaper crude, which we're not seeing at the moment. John Hardy, Saxo Bank, head of FX strategy, joins us now. John, what's your dollar call?
Well, I think the dynamic here we're looking at is the market is looking at the Fed normalizing. We're looking at U.S. Treasury yields, and those processes are supporting the dollar. This sense that the EU fiscal outlook is sidelined, that the major excess savings countries are sort of recycling their savings into a country which is about to tighten policy, that is the U.S., is supporting the dollar. So I think this process could continue a while. I think interesting, the move yesterday, there didn't seem to be any specific prompt to it. Some would argue that means it's of better quality than otherwise, but we are at quarter end here, so I'm curious to what degree this quarter end effect may have caused a bit more of an acceleration than we might otherwise have seen. Yeah. So we'll see how this the dollar finds its legs early next week as we look forward. I think the sooner we get to a German coalition and EU fiscal impulse, the quicker euro dollar bottoms out.
So, John, what's your focus when you look at the markets? It seems we've seen so much volatility on pound. How much more volatility could we see, and actually, where does it settle?
Yeah, I have some concerns about sterling. We have this sense there's been quite a change in sentiment around sterling with this big energy crunch. I think some of that is justified. The sense that there's capacity constraints, some of that linked to Brexit, some of that linked to the structure of the economy and excess demand injected into the economy during the pandemic relative to the labor that is available. And we have that sense of labor shortage. So it just seems that with that constraint, with the energy crunch, with the sense of isolation and vulnerability, and a government looks like it's headed towards some attempt at fiscal credibility and therefore austerity. These are not supportive factors for the pound. I think traders were very much offside post the German election, which nominally should have looked like a slight euro negative, and it wasn't. So I think euro sterling looks interesting as sort of a key of where sterling is relative to where, whereas sterling versus dollar is more about the U.S. dollar right now.
Given the hawkish turn of the BOE, is this pound weakness not overdone?
Well, that's what's been interesting, because that hawkish drumbeat has been there for quite some time in the background, and nonetheless, sterling was really indifferent to it and not trading off that. I think it's these other considerations that I just listed up that are more more what is impacting sterling at the moment. So yeah, I have concerns about the sterling devaluing a bit more here.
And then when we look towards China, John, there is some conversation now that the weak manufacturing PMI print we got overnight just means easier policy. So how do you think about the yuan?
Well, I think about the yuan as being extremely managed. We've noted in recent days, of course, with this big surge in the U.S. dollar, the renminbi is virtually unchanged, suggests a highly managed exchange rate. Maybe some of that stability is desired on the part of officialdom ahead of their big long week, holiday week here through next Thursday, starting tomorrow. But I think on the other side, you have capital inflows that have been sort of chased away by this huge policy shift and the uncertainties that it has generated. So, theoretically, I think we should be seeing a somewhat weaker Chinese renminbi, but the question is to what degree market forces would be allowed to affect the exchange rate. Their commodity import prices, of course, are soaring now, especially on the energy side. So there is some justification for keeping a strong renminbi on that front. So it's what the officialdom wants to do with it. I think the underlying fundamental pressures are for a significantly weaker currency and a need to ease eventually.
Right. Right, and you mentioned the strong dollar there. I want to bring it back to the greenback. The start of this year, we had very short positioning. That started to flip. Where are we now, John? What does it tell us about the pain trade?
Well, the pain trade is still higher on the dollar. We've seen a lot of that positioning has been reduced, certainly. But there's certainly more on the pain side, especially the longer we get this sense that we're in perma-QE and the big excess savings economies, Japan and Europe. And as long as there's this big differential stretching out over the horizon, I think it tends to feed a stronger dollar. If we get EU fiscal back on board early next year, if we get fiscal uncertainty in the U.S., which I think is coming fast and furious, if you will, I think that the move does peak out and we start to roll over and see a weaker dollar before the end of the year. I could be wrong by a month or so on that, but that's my anticipation that we see a turnaround and a pivot sometime in Q4.
So does that mean those yield differentials then are more important than capital flows?
It's both. I think you would need to see because monetary policy seems so stuck in the mud in the other zones. You need to see the fiscal policy coming on board to encourage a positive. Certainly in the case of the euro. The euro is too cheap, but we need to see something on the political front, breaking of the logjam and some stimulus that keeps capital at home and investing domestically. Maybe this energy crunch is the thing, and it should be the thing. This is a galloping crisis that prompts more action from the EU politicians from here. It seems to be they seem to be sort of sailing cluelessly along here on this issue. We need to see some political leadership to address that issue, certainly.
Thank you so much, John Hardy there of Saxo Bank with the very latest on some of his FX calls. Now, Nicolas Sarkozy was convicted moments ago of deliberately overspending in his failed 2012 re-election campaign by French judges. What we found out moments ago, it takes quite a long time in France for the judge to actually read the verdict. He will get 1 year jail term in overspending case, but actually he will not actually be in jail. So I think he just has to wear an electronic bracelet, which means that he could probably stay at home. It's really another humiliating defeat for Sarkozy, who was convicted of corruption earlier this year, but he does remain still quite influential in France, well-liked amongst right-wing voters. We'll have plenty more, of course, on France and the upcoming election next year. Coming up next, though, Julie Norman, University College London lecturer in politics and international relations. This is Bloomberg.
Watch Bloomberg Surveillance to stay on top of the latest market trends, commodity trends, and fashion trends.
Are you going out for a fitting on a base suit?
I'm going to go and get a base suit. The crowdfund was very profitable.
$100,000.
About 100K, which is what it would take for me to wear that suit on this network. How do you get that bulky fit? I'll find out. I'll have a chat.
You
get the bulky one.
You know, I'm channeling the president.
Look at those markets.
Don't taper the pants. They
John,
put
you
futures
look
down
so
6.
good in a base suit.
Dreaming.
The growth story in cannabis remains very strong, even after the sort of the loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
This is Bloomberg Surveillance, early edition. I'm Francine Lack with Danny Berger in London, Kaylee Lyons in New York. Now, President Joe Biden is making his pitch to both parties on Capitol Hill. Last night, the president attended the congressional baseball game where he distributed Dove ice cream bars printed with the presidential seal to the players. Well, Biden is poised to avoid a disruptive shutdown of the federal government, but deal-making continues on his economic agenda. Well, joining us now is Julie Norman, teaching fellow in politics and international relations at UCL. Julie, thank you so much for joining us. Look, there's progress. At least we don't have a government shutdown for tomorrow. How difficult will it be to actually, keep Democrats all on side?
Well, Francine, there's a lot going on in Washington this week, and you're right that the most urgent crisis will most likely be averted. We'll probably avoid the shutdown that would have otherwise occurred tomorrow. But for Democrats, there are still 2 big bills that are in play, and we see this rift that's kind of been there between the moderates and the progressives just growing ever wider as we lead up to these votes. It's expected today that there will be a vote on the $1.2 trillion infrastructure bill. This was the bill that was a bipartisan bill, had 19 Republican votes in the Senate, has been sitting with the House for several weeks now, and is just waiting for their vote. Many of the progressive members of the Democratic Party have said that they will not support this bill unless it's moving in tandem with the Democrats' much larger spending package. And so they are trying to get some movement on that before committing their votes.
Yeah, so Julie, help me understand the progressive calculus here. I'm trying to figure out how it is more politically advantageous to risk tanking President Biden's entire economic agenda than it is to risk maybe having $1 trillion less in social spending if they vote for the bipartisan package first.
Well, that's exactly right. What we've seen progressives trying to do is use their leverage as much as possible in the lead up to this vote. They're trying to push for some kind of concessions, either a number from moderates or a kind of legislative plan before committing to the infrastructure bill. But at the end of the day, if they don't support the infrastructure bill, if the infrastructure bill dies, they will have very little leverage moving forward after this. They will just get more animosity in terms of passing the spending bill, and it will actually hurt their case in the long run. So we see them trying to maximize their leverage today, but when the bill actually comes up for a vote, it's in their best interest to move that forward, to move the whole party forward.
Does this issue resonate with voters? Julie, is it go beyond not getting this economic package passed, but also impact the midterms?
Well, that's certainly a concern for many Democrats, and that's why we see the progressives on the one hand really pushing down for what they see will be popular in their districts, some of the policies that are part of the larger plan, such as early childhood education, different kinds of tax credits, climate, et cetera. But at the same time, many of the measures that are in the infrastructure bill are also just crucially important to those same districts and districts across the country. Traditional infrastructure such as roads and bridges, but also broadband, clean water, and other issues that are really quite pressing for individuals across the country. So while this is politics playing out, it's also real policies that matter for many Americans in both progressive and moderate districts.
Julie, who are the senators you actually want to hear from? So apart from Manchin and Sinema, is there anyone else that we need to find out exactly what the thinking is on the tax position, but also on the spending bill?
Well, Francine, for right now, the two senators that are getting the attention are Sinema and Manchin, of course, and they are the two that I think are going to be the real deal makers on supporting the larger bill. And Manchin made a pretty long statement yesterday referring to the fiscal insanity of the current Democratic plan and really pushing for weeks, if not months, of negotiations around that. So he and Sinema are really going to be the two senators that we're focusing on. There's several House moderates as well that have been pushing for a bit more clarity around the infrastructure bill and around the stimulus bill. And so this isn't just limited to the Senate, but right now Manchin and Sinema are the go-to people to make this happen in the upper chamber.
Julie, obviously it's Congress that can make or break this long-term economic spending plan, but at the end of the day, this is President Biden's agenda. What does the Biden administration do if Delta loss here?
Well, that's exactly right. This is two key pieces of Biden's agenda in terms of big policy initiatives, but also in terms of the process. The infrastructure bill in particular is a key piece of legislation, but it's also a key piece of bipartisan legislation. And it's really important for Biden that gets through to show that he was able to make bipartisan deals work. The larger spending bill is also really crucial for Biden. Again, Democrats, I think, realistically know they have until really the midterms of next year to get something big through. That package includes a lot of the many more progressive policies that Biden and the party more largely want to see move. And so these two pieces together, but especially I would say the infrastructure bill, are very crucial for Biden right now. He's coming off a low period with the Afghanistan withdrawal, approval ratings at the lowest that they've been since his time in office. He needs a win.
Julie, from our point of view where we sit looking at the markets, the concern over the debt ceiling has been pretty minimal. Where would you put the odds that we do indeed breach the debt ceiling?
I think both parties and the Democrats right now controlling Congress know that cannot be breached. Something needs to happen to prevent that, and I think they will make the necessary steps. We've seen Republicans making that difficult for Democrats this week, blocking several of the measures that would have already had it go through. Democrats may, in fact, be forced to use the reconciliation process to raise the debt ceiling. It's not something they want to do. It's not politically palatable for them. But if that's what they need to do, they will do it. I think we've heard very clearly from Secretary Yellen some of the risks that are involved for the larger economy as well as for taxpayers, and no one wants to see that happen.
Julie, thanks so much. Julie Norman there of UCL. Now, coming up on Bloomberg Surveillance, Bob Woodward and Robert Costa, co-authors of the new book, Peril, which details the transition from President Trump to President Biden. That interview at 8:30 a.m. in New York, 1:30 p.m. in London, and this is Bloomberg.
from New York City.
We're here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Think of people whose jobs have now been displaced by this big step that business has taken to digitalization, who have no financial assets to begin with, so they didn't benefit from what has happened to asset prices. And in addition, they were hoping to buy a house and they've been priced out of the housing market. So suddenly both their actual and potential wealth and income has declined.
A Bloomberg opinion columnist Mohamed El-Erian discussing inequality caused by the pandemic. Now, El-Erian is one of the three Wall Street titans featured in today's Big Take on the next big risks for investors. Now, talking about big risks, Tom Keene, co-anchor of Bloomberg Surveillance, joins us. And Tom, you're looking at the S&P.
Well, I'm looking at the S&P and the Dow. The S&P is way more accurate in terms of the wholly holistic market. But you know what? People still follow the Dow. And what I see here is something is odd. We have real market movement. You know, Francine, in sterling. You know, in the dollar, stronger. Some fixed income dynamics as well. And the equity markets are shockingly on bid. The long-term chart from the pandemic showing correction in yellow, bear market in red. Yes, we had a bear market off the pandemic horror back in February of a year ago. And then really it's been remarkably quiescent and with a movement upward. And the drawdown here in the equity market is remarkably small, Francine, on a Wednesday morning versus what we see in other markets, particularly dollar dynamics.
Tom, we're going to get a lot of economic data out in the next 28 hours or so between jobless claims, GDP, PCE. What catches your eye the most?
What catches my eye, without question, is what is 12 months forward growth on China. John Farrell's been on top of this. He's correct. It's all that matters. El-Erian and others would say 6% is the bogey for China. They've got to keep a 6% level to keep their employment model going, and they're not there. Goldman Sachs marks them down to, I believe, a 12 months forward 4.8%. And that's not good enough, and that redounds right over onto U.S. data.
I mean, do we just give up of dreams of synchronized global growth now, Tom?
That's a really nuanced question, and the answer is I don't know if we were ever synchronized to begin with. The synchronization came from the marginal impulse of China. Project Syndicate launches at quarter end today, a fabulous 6-7 voice review of China. Raghun Rajan, Kenneth Rogoff, Stephen Roach, and others, and it's really, really an important set of documents just about that. And the answer is the synchronization came about by the growth of the marginal growth impulse of China, and the major question is that gone?
Right, but more than deceleration now, we just need to look at stabilization signs from China, Tom. And we hear it from the Chinese authorities actually asking financial institutions to make sure that property buyers are okay because of the cooling housing market.
I strongly agree with that. You know, you read your Elizabeth Economy, you read the others, Francine, and they're going to tell you when in doubt, they always, in every case, stabilize. And I have to admit, I'm in the camp. You could phrase it any way you want, Francine. Beijing to the rescue.
It certainly looks like that, but we have to also look at how far they're willing to go and how far they're willing to pay. Tom Keene, a pleasure as always, co-anchor of Bloomberg Surveillance. Now, this is what else we're watching today. Kaylee, you're in politics in the U.S.
Yep, watching Capitol Hill. It looks like we have a budget deal will avert a government shutdown, but the infrastructure package is the massive question. Nancy Pelosi will bring that $550 billion bipartisan package to a vote. Will progressives sail it through, or will they tank it? That is really the question. Of course, the progressives want to see more progress on that $3.5 trillion socially oriented spending legislation first. So you could see a make or break day for President Biden's economic agenda today, Danny.
Well, I am looking at something that we all love, and it's travel. You have G7 ministers for health and for transportation meeting today. Sources telling Bloomberg UK is hosting it. They're the de facto G7 president this year. The question they're going to be trying to solve is, how do you restart international travel? How do you make it more easier? How do you have transportation departments versus the highest levels like the White House making these types of decisions? So it's going to be that. It's going to be vaccine passports. I think we could get some very interesting changes coming out of this, Francine.
Yeah, what I'm watching is the UK. So I'm watching the end of furlough and trying to figure out exactly what the impact for workers will be. The other thing is, of course, this huge repricing of the markets. Now the market's expecting 3 Bank of England hikes next year as inflation risks mount in the UK. This, you couple it with the faster rebound than expected in terms of GDP in the UK. So there's quite a lot going on. It's probably one of the most interesting, but also volatile economies, certainly when it comes to traders changing on pound. More Bloomberg surveillance up ahead. We'll hear from Michelle Meyer, head of U.S. economics at Bank of America Securities, amongst others. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
To exit this year and go into 2022 with a synchronized global expansion.
When bonds and equities are selling off together, historically that actually means a very positive environment for the US dollar.
We could be seeing much stronger manufacturing activity, but we don't have sufficient supply.
We may have seen the bottlenecks shift from sourcing to logistics.
There is a big income hit coming for those households at the middle and lower end of the income distribution.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Wrapping up Q3 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Elisa Abramowitz. I'm Jonathan Ferro. This Thursday morning, futures positive 21 TK, wrapping up Q3 with the S&P 500 up 0.5%.
Yeah, I'm doing an audit here on September 30, John. I'm counting out the vacation days you took from me, and I don't have enough fingers to take.
Are you worried about your Christmas vacation already, Tom?
Yeah, and I'm going to be off the last week of the year. Thank God I'm taking 5 days this year. Okay, into Q3. John, it's been a really twisted quarter. And do you have a vision on Q4? I don't.
I don't have a vision on November, Tom. October, never mind the whole of Q4,
exactly.
Or January 22 for that matter either. We had a rally yesterday, but it was really defensive, led by utilities, staples, healthcare. And in the mix, TK, that dollar move got your attention, my attention, Lisa's attention. That was a big move.
Tangible dollar move. I thought Bloomberg's FX desk did a great job on that over at the markets team. It was, John, elements of a jump condition. And what's interesting is you're right up against whatever the trend, support or resistance. And if you go further from here, that's substantial.
Euro dollar a break at 116, 115.95. Who wants to take the DC mess? Any takers? Lisa, you fancy it? What's happening in Washington?
They're playing a baseball game.
It's a mess. Thank you, Tom. I'll go with that. No, honestly, they are going to kick the can down the road to December. I think that is what we're going to see this morning as they move the extension for the deadline, I believe, to December 6th. So they have to negotiate until then. Look, I think it will be very interesting to see if the House votes on that $550 billion bipartisan infrastructure bill today. Can Pelosi get some of those progressives on her side to pass that without the other bill written and sealed?
We can hardly wait. Down in D.C., Anne-Marie Horden, a Washington correspondent, standing by. She'll be with us in about 15 minutes' time. Let's round out the price action for you this Thursday morning. Jobless claims coming up a little bit later. A repeat of Chairman Powell and Secretary Yellen. Lisa will give you the times for that in just a moment. Your equity market with a lift, up 22, advancing 0.5%. We are heading for a 6th straight quarter of gains on the S&P 500. Into the bond market, unchanged. We settled down, we stabilized, Lisa. Yields on 10s, 151.67.
Yeah, there seems to be a stasis. And I do wonder how much it's because of the extension, the kicking the can down the road, taking the potential for default off the table. It might never have been on the table. Your excitement can be fully expressed later this morning, John, 7:45 a.m. The Assistant Speaker of the U.S. House of Representatives is joining us, Catherine Clark, and we could talk to her about how challenging it has been to wrangle support from both the progressives and the moderates in the Democratic Party as they try to just get the bipartisan bill through so that they can really get something lined up on the other side, on the human infrastructure plan that a lot of the Democrats would like to see it passed. 8:30 a.m., we do get a read on the U.S. labor market, U.S. initial jobless claims. We're also going to be getting the third print of the second quarter GDP. No drama there. We are expecting a continual drop down in the number of initial jobless claims. Here's what I'm watching. The participation rate of people 55 years old and older, it has absolutely tanked. It has not recovered at all. This, to me, is so interesting. It indicates that people are dropping out of the labor market. They are retiring early, and they can because their assets are worth a lot more. So they actually have more money in the bank to give them confidence that they can afford to retire early. And then at 10 a.m., Fed Chair Jay Powell, as you were talking about, and Treasury Secretary Janet Yellen are testifying before the House Financial Services Committee. Expect them to talk about some of the supply chain disruptions. Expect them to face a lot of very interesting questions. Just, you were citing this before, John. Senator Warren said, over and over, you have acted to make our banking system less safe, and that makes you a dangerous man to head up the Fed. That is what she was saying about Jay Powell. Will Treasury Secretary Janet Yellen publicly support his renomination, and how much will progressives get on the bandwagon that Senator Elizabeth Warren set out, John?
We will see. I'm listening out for more of this from Chairman Powell yesterday on transitory, Tom. This is a process that will have a beginning, a middle, and an end. Oh, did that help?
Brilliant.
No, John,
that's where we're at.
Where we are now, and Greg Villiers finished his early morning note on this, folks, is how do you affect monetary policy, John, with such fiscal uncertainty?
No idea.
No way.
It's a really good point, Tom.
In the history of the Fed. It's not my point, it's Villiers' point.
To something we've talked about a million times, TK, through Q3 into Q4. The range of outcomes for next year, never mind year end, just incredibly wide still.
Well, it is. I would like, John, everybody to calm down. I'm going to hallmark some Q3 returns here. How about Amazon? Everybody's beating up on Amazon. It's absolutely cratered over the last 90 days, John, down about 4%.
Yeah, and the broader market?
It's horrific.
Broader market positive on the S&P.
Yeah, we got to put things in perspective here.
We're trying to do that, Tom.
We're trying to
do
it.
Okay, we'll
It's
work
difficult.
on that with George Bory now from Wells Fargo Asset
Please.
Management, the head of fixed income strategy. George, let's start there. The playbook for Q4. What is it, George?
Yeah, good morning, everyone. Well, the Fed has two big challenges right now. Number one, you've already touched on all the main themes to watch, what to watch right now. But the Fed is trying to do two things. Number one, it's trying to recalibrate the bond market. If you think back about a year ago, bond yields were down. 10-year bond yields were down down to around 50 basis points. We kind of ran all the way up to about 1 3/4 earlier this year, and we're back down to about 50 basis points. This is a long, drawn-out process. The Fed has a very challenging job that it faces as it tries to sort of allow the bond market to adjust to what will ultimately be tighter policy. They are in the process of trying to unwind the extraordinary policy that they implemented, sort of last year in response to the upcrop of COVID. That's a very, very real challenge. And then the second issue, and as you just mentioned, is they're responding to everything around them, in particular Congress. And so they're almost stuck in kind of a wait and see mode right now, of wait to see what Congress ultimately presents, what they're able to pass, what they're actually able to do. And then the Fed can sort of recalibrate. All of that's going to come together in the fourth quarter. Our view is, go ahead, Lisa.
Well, no. Elaborate on your view here, because we're expecting the Fed to start tapering regardless, right? That is the plan, and real yields are moving up. People are expecting that. Elaborate on your view.
So real yields are moving up, and our view is that they will continue to move up. But the Fed is trying to, as I mentioned, they're sort of trying to recalibrate the bond market. They want yields to go up, but not too fast. They want yields to be more in line with sort of the broader economic growth. But as you mentioned, there's a lot of uncertainty. Is that economic growth going to be sustained as we go into next year? A lot of signs that growth is decelerating. But again, as Tom just mentioned, we got to put things into perspective. We're coming off of extremely high levels, whether it's growth, whether it's asset prices, or extremely low levels, whether it's yields. And it's that recalibration process that the Fed is trying to slowly inch us towards. If we think back to when the Fed last tapered, bond yields went up pretty meaningfully over the course of about 3 months in late 2013. We're sort of seeing a little bit of that right now, and we think that's ultimately what's going to happen as we go into the end of the year. Bond yields go up, they don't skyrocket higher. The Fed is clearly in control, but bond yields should ultimately go up. So another quarter basis point from here, not a heroic move, but very, very likely in our opinion.
George, what's the how of bond, note, and bill ownership right now? I get the why, but how do you actually affect a strategy assuming price down, yield up?
Yeah, no, that's a great point. I mean, it's a headwind, and we can see that if you look at total returns for high quality bonds. The Treasury market's down year to date on a total return basis. As you broaden out that spectrum, returns improve, and I think that's our central message to clients: is that in an environment when bond yields are actually moving higher, you have to diversify your sources of income. Your income, the amount of coupons you're getting, as small as they might be, are critically important to your return, to your total return, to your ability to preserve capital. And so that's really what we've tried to do in our strategies wherever possible. Diversify your sources of income. It starts with, money markets don't offer much. They don't offer anything for the most part. But as you incrementally go out the curve and down the rating spectrum, you can enhance that yield. And we're still in a pretty robust economic backdrop. So we're still comfortable taking that credit risk going down, taking some default risk. Defaults are effectively non-existent right now for the most part within the corporate sector. That's not going to last forever, but it's going to last for a while. And so we are still comfortable taking that incremental credit risk. It's in munis, it's in corporates, it's in structured, and that extra yield is what ultimately protects you against that higher term structure that the Fed is trying to orchestrate. And I think that those returns within the bond market are another factor that the Fed considers. If those returns drop too fast, get too big and drop too fast, they have to mop up the mess. So that they are willing to sort of go slow in an effort to allow that bond market to sort of recalibrate. And that's exactly what we're trying to do in our portfolios with our clients.
Yeah, you know, John, George Bory has no clue how I've blown up my bond portfolio.
I know.
That 99-year Austria I went into, that has really performed here.
That's how you do it,
in the
Tom.
last move. I'm down 32% since, you know.
Own a century bond. Going into the collapse of duration. That's a great idea, Tom.
Yeah, it's in the estate for
Lever it up.
George Bory, thank you, sir, for setting the tone for this program this morning. Wells Fargo Asset Management Head of Fixed Income Strategy. We need to build on this through the hour. We need to talk about foreign exchange as well. Jordan Rochester of Nomura joining us at about 20 minutes time, Tom. The dollar index this morning with a 94 handle on the DXY. What has underpinned this dollar move in the past week? The underpinning of that dollar move, how durable is it, and what does it mean for what I own, Tom, and where I want to own it? Questions for this hour.
The dirty little secret, folks, is a lot of the guests that we have always write consistently an average, and then they kill you every 7 days with a brilliant note. We saw that this morning, John, from Kit Jukes at Societe Generale, and he looked at flows. He looked at deficit nations, surplus nations, and it's flipped on its head to strong dollar.
Yep, and that's been a story. Here's the quote from Kit. The Fed has sounded the starting gun on monetary policy normalization as the U.S. escapes the interest rate zero bound, leaving the Eurozone and Japan behind. The global savings glut is set to be drawn towards the dollar. We'll talk about this a little bit more through the next couple of hours. From New York City this morning, good morning. Tom Keene, Lisa Bramis and Jonathan Ferro on radio, on TV. Q4 just around the corner. Where did 2021 go? This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Congress and President Biden are set to avoid a disruptive shutdown of the federal government with just hours to spare. It's the eve of the new fiscal year, and the Senate and House are expected to vote to extend government funding until December the 3rd. Meanwhile, deal-making continues on the president's economic agenda. The House plans to vote today on an infrastructure package that underscores deep divisions amongst the Democrats. Federal Reserve Chair Jerome Powell and his international counterparts have renewed their assurances that a surge in inflation is temporary. At a virtual panel event hosted by the European Central Bank, Powell said the spike is really a consequence of supply constraints meeting very strong demand. He said that's all associated with the reopening of the economy. And it's the latest sign that China's economy is slowing down. Activity in the country's factory sector contracted this month for the first time since the pandemic began. That shows the damage a widespread electricity shortage is having on growth. And in France, former President Nicolas Sarkozy has been convicted of deliberately overspending in his failed 2012 re-election campaign. A criminal court found that Sarkozy spent roughly $50 million, about twice as much as was legally allowed. Prosecutors has asked for a 6-month sentence. Earlier this year, Sarkozy was convicted of corruption. First, the UK started suffering a shortage of truck drivers. Now lobbyists in post-Brexit Britain warn there may not be enough bankers. International staff make up a fifth of the 1.1 million people working in the UK financial services. But according to lobbyists and consultants, Brexit is making it harder and more expensive to hire foreign staff. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How is Ireland dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that of course is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Democrats don't want to shut down the government. Republicans don't want to shut down the government. That will supply the result that we all expect, which is to keep the lights on. The only question is how long the continuing resolution will be for.
Senator John Cornyn there of Texas. From New York City this morning, good morning. Tom Keene, Lisa Abramis and Jonathan Ferro. This Thursday, as we round out Q3, here's the price action. Equity futures up 20 on the S&P, advancing by about 0.5%. We are looking at another quarter of gains. We settle down. We settle in and around 150 on the bond market, on 10s, yields 150, 167, unchanged on the session. The dollar index, the strongest so far through 2021. Euro dollar, it's a clean break at 116, Tom. It's 115.92 on euro dollar.
Yen 111.91, and the talk of yen to 113, somewhat unimaginable for many. One of the strengths of surveillance, folks, besides Lisa Abramowitz, is Pharaoh and I look at England, and when we talk Brexit, I go to Mayfair for dinner. John actually looks at the American political system with a twisted parsing view. And John, you've got an observation.
And sometimes with confusion, I think for a lot of people from the outside looking in, trying to understand what exactly is going on, it's difficult. Let's do that now with Jack Fitzpatrick, Bloomberg government reporter. Jack, help me and others understand the difference between avoiding a government shutdown and lifting the debt limit.
Yeah, so for one, the debt limit is the much more serious issue. So when you hear positive talk from the Capitol saying we're not going to have a shutdown, that's not the greatest news. It's good news to avoid a shutdown. But one, to fund the government, it means to avoid a shutdown. In a shutdown of the government, at least parts of the government wouldn't continue to operate. There would be some government employees who would have to go home and not continue working, although many workers are essential, so a lot of government programs would continue to operate. You'd see things like national parks closed down in some cases and that kind of thing. A default on payments is what would occur if they were to go beyond the debt limit. That would be probably catastrophic. Catastrophic is the word that the Treasury Secretary has used. It hasn't happened before, so exactly the way it would work out is a bit confusing, but that could lead to a lack of payments on bonds, a lack of payments that the government needs to make on a variety of bills, and it would shake faith in the U.S. government actually being able to pay its bills rather than shutting down, which is sort of pumping the brakes on the operations of the government.
Jeff Fitzpatrick, I want to go granular right now. I want to talk about the grizzled politician of multi-generations from Flint, Michigan, Dan Kildee. He's out there whipping up votes for Pelosi. He made clear he doesn't have them. Would you explain the negotiations between someone like the gentleman from Flint and the liberals in Congress, his liberal party? How does that happen?
Yeah, so I believe he has said he doesn't have them right now on the infrastructure bill coming up. The plan was to hold a vote today on the infrastructure bill, but we've talked a lot over the last couple months about the pairing of that bill with the broader social tax and spending reconciliation bill. There has not been enough progress on that bill, so progressives are saying they're going to block the infrastructure bill that moderates are more motivated to get. We don't have an exact whip count because there could be some moderate Republicans who join to vote for the infrastructure bill, but probably not many. So this two-track procedure that they're going to try to do, separate infrastructure and tax and spend bills, has gotten tripped up because of what you've seen with Senators Manchin and Sinema in the Senate and the lack of an agreement on the top line for the reconciliation bill. And if one gets tripped up, then the other appears to be tripped up as well.
Jack, I want to go back to this idea of the debt limit as well as the spending plan, because what it seems to me is that we still have the potential for some sort of disruption in payment, even though we have an extension in the spending of the government. Can you parse through what needs to be done to avoid the jitters that come with a potential default, which has not happened?
Right. The debt limit deadline is never entirely clear until you basically get to it. Secretary Yellen has said it's probably about October 18th. There really is not negotiation happening in the Capitol on this. Both sides are entirely dug in. The big question is, can Democrats come up with a plan B? And so far, the answer has been no. So this is a much more serious issue that people probably should be nervous about compared to the possibility of a shutdown, which is more minor in its consequences and doesn't look like it's going to happen. But over the next 2 to 3 weeks, this is a significant issue with the debt limit, because I've talked to a number of Democrats about what their next plan would be after Republicans blocked a debt limit suspension. And the answer is really they don't have a plan B. Both sides are very dug in, and it's probably an issue where lawmakers wait for some sort of market panic or wait for somebody to blink on the other side before they get creative and come up with something to do.
Jack, how big of a deal is today the fact that House Speaker Nancy Pelosi is holding a vote on that bipartisan bill? How important is it to determine how much unity, how much cohesiveness there could potentially be in the Democratic Party?
Well, we'll see if they actually hold that vote on the infrastructure bill, because it's probably not going to do a lot of good to hold a vote if they don't have the majority. That's one of the main issues of the day. Again, it's been turned into such a complex thing that this infrastructure vote wouldn't tell them about their support on infrastructure. It would really be a result of the way this has gotten tied in to the broader reconciliation bill and the way the Senate has held up what House members want to do on that reconciliation bill, and then has proceeded to kind of pit the two wings of the party together. The issue comes down to a couple of people, and if they can get a top line offer from Senator Manchin and Sinema on what they'd be comfortable for the other bigger bill, that would move things along for infrastructure. But if they don't get that, it's not entirely clear they're actually going to hold the vote if this gets blocked by the progressives because of their concerns over the reconciliation bill.
Have we got the baseball pictures from last night? Tom, should we do that? Jack, did you go to the baseball?
What do you mean, the Red Sox beating the Orioles?
No, he had to wake up for this.
I was thinking about the Democrats, Tom, versus the Republicans. Do you know who won, Jack?
The Republicans won, I think, by 1 run. They 13-12.
Okay, 13-12. That's a lot of runs. Okay.
The defense is bad.
Did you watch any of this, Tom?
No, I don't get much out of it, but I must admit it is a wonderful Washington tradition. There is some criticism that they're doing this within the issues at hand, but maybe it's a little way to keep grace going. What I see, John, and Jack, I think, nailed it, is I just don't understand where traditional politics fits into this split Washington and split nation.
Where'd you get those ice creams, Tom, with the presidential seal? How did we get hold of them? The president giving them out last night.
Yeah,
very cool.
Swag, it's great.
Jack, thank you, sir. Jack Fitzpatrick, a Bloomberg government reporter. Anne-Marie Hordern clearly was at the baseball last night.
Oh, there's no question
when
about
she
that.
joined us? 2 hours?
Yeah, I don't know.
3?
She had to sleep in.
Did she? Tom Keene, Lisa Abramowitz, and Jonathan Ferro. Your equity market up 16 on the S&P, advancing 0.4%. I like that tradition. We should do that here at Bloomberg. Do you want to play baseball, Tom?
Oh my God, we'd be so competitive.
150, 185 on tens.
You know we would.
From New York. I cannot play baseball. I'd still be competitive, though.
You would still trade.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Looking to wrap up a choppy Q3 from New York City this morning. Good morning. Here's the price action. Positive 14 on the S&P, advancing 1/3% on the quarter. Coming into the final day of the quarter, up for a 6th straight quarter. The longest quarterly winning streak going all the way back to the end of 2017. Equity futures on the NASDAQ up 0.4% on the small caps. The Russell down on the quarter just a little bit. We advanced there by 0.6%. Switch on the board and get to the bond market. 2s, 10s and 30s. Trick question for you. Where do you think Treasury yields are on the quarter, given how it feels? Tom Keene, they're up 5 basis points. Does it feel like we're only up 5 basis points on the quarter?
As you mentioned at the beginning, it's the volatility.
It's how choppy it's been. Couldn't agree more. 152, unchanged on the day. 2.06%. Was that your impression of me? Because that was quality. That's the bond market. Here's the FX market. Just quickly for you, Tom. Thank you. Cable, 134.42. No one thinks I speak like that. We're positive by a little more than 1/10%. A bit of sterling strength after some real sterling weakness, Tom. This one is getting harder and harder to read. And that's the point coming from Jordan Rochester of Nomura. Looking forward to catching up with him.
Let's stop the show. This is important.
I thought we stopped the show a minute ago.
Yeah, no, we're stopping it now. What does Prime Minister Johnson want? Does Prime Minister Johnson want weak or strong sterling?
Given where the inflation numbers are, Tom, given the issues we have with energy, I imagine they want a stable one. Is that okay?
That's okay. Continue.
I imagine the government would like a stable currency. I imagine right now Governor Bailey does not want any more pressure to hike interest rates.
So continue. Michelle Myers taking notes.
134.41. Michelle's talking about Christmas in September. Let's get there, Tom.
Let's get
Christmas in September. You want to do Christmas in September?
Let's do Christmas in September right now. Michelle Meyer with us with Bank of America. And of course, they've got a granularity which she helped invent out of Boston University in housing and in the American consumer. Discuss Christmas in September. Really, Michelle?
Yeah, you know, it's not obviously quite Christmas in September, but the idea is that we are seeing evidence that consumers are spending earlier this holiday season. And, you know, when you look holistically at the aggregated Bank of America card data, September showed some real momentum. And part of that is this broadening of spend across goods, and particularly in areas like clothing and electronics, things that are most sensitive to holiday sales, which could be a function of this pull forward of holiday spending. But you're also seeing this kind of mini re-engagement on the leisure side too, which has been super encouraging. So the card data we've been following has been really quite positive for the consumer and making me feel pretty encouraged as we head into the next quarter.
Yeah, but everybody knows we're just pulling forward from December 23rd when I begin my shopping. Great. Have you adjusted your GDP view? Our theme today on September 30, no visibility Q4, no visibility Q1. Give us some visibility.
Yeah, well, I think we're seeing just that with our high frequency data, that we're setting up what should be a better Q4. So Q3 GDP is coming in right around 4%, give or take a few tenths here. But Q4, it looks like, you know, our baseline forecast has been for 6% growth. And I'm holding to that number. And the data that we're tracking, the high frequency data that's inflecting higher, suggests we could very much succeed on that forecast for 6%. So I think the demand is there. The indications are that we're seeing this re-engagement in the economy start, which is really encouraging as COVID cases come down. The real question will be on the supply side. You know, how much capacity is there to realize the strength that we're now seeing on demand?
And the flip side of that is higher prices, which we're seeing in a whole range of places, right? And I'm wondering, you know, the sort of stickiness here that we're looking at going forward and the disinflationary kind of trend that people were talking about before, when people are spending more for the same amount of stuff. What's your view on how that's affecting consumer sentiment and their willingness to spend?
Yeah, I mean, that's exactly right. There's all this demand out there and there's limited supplies. And unfortunately, the supply chain issues have gotten worse, not better. So that's a real concern. And what that means is that there will be, you know, higher prices. They're already seeing it and they will continue. And if people are buying early in the holiday season, it means that you probably don't have the same level of discounting that you've had in prior holiday seasons, especially in an environment with low inventories. So what does that mean? Well, consumers are taking notice, right? Look at the University of Michigan survey. people are more discouraged because prices are high and they can't get some of the items that they're looking to purchase. So when you consider adding up for GDP, you're looking at in real terms, inflation adjusted terms. So you could get this bigger divide where nominal really, accelerates into the fourth quarter, but real GDP maybe struggles a bit more. So that's something that we're keeping an eye out for when we think about these supply constraints.
Your specialty is the housing market. That's where you made your name, and we're watching the housing market actually embody this inflationary push, possibly more than any other. The idea of 20% year-over-year gains month after month after month. How does this factor into discretionary spending, to inflation more broadly, at a time when Jay Powell says that a lot of this is just transitory and supply chain related?
Well, look, I think housing is a perfect case study of this imbalance between demand and supply in the market, where demand has just, climbed higher in the housing market in a very constrained environment. Now, builders are responding. That's good. Inventory is picking up. Look at the new home sales report. The month supply figure there is now touching around 6 months. So that's quite good. We're making progress, but we're not at a point yet where home prices are starting to cool. We're not at a point yet where you've kind of lost some of the frenzy in the market. It's still there when you look at the number of days in the market for sale for these homes. Things are moving quickly. There's also a lot more cash buyers. There's a lot more investors in the market.
Yeah.
So what does this mean broadly? Well, it does fuel this kind of inflation sentiment. It's one of the factors that you want to think about when you're considering inflation expectations and how people perceive the inflationary environment. But then also just more on a nuanced view, right? It does ultimately impact the rental market, which ultimately impacts owner's equivalent rent. And that's starting to show through very, very clearly in the high frequency data. So we should anticipate that owner's equivalent rent moves up into next year, even if some of these more transitory factors that have been boosting inflation wane.
That's great to hear. Michelle Meyer in her wheelhouse when we first met her a zillion years ago out of BU. Michelle, I want to talk here about transitory, and it's what everybody's talking about in these two Americas, and one of them is an America flat on its back. Is a negative real wage here to stay, or is a negative real wage transitory?
Well, right now it's particularly painful on a year-over-year basis because you've seen these extraordinary gains in inflation. But when you look forward, I think the wage environment is quite positive, particularly for the lower income consumer that's going to be a lot more sensitive to moves in inflation. So I think, given the incredible demand for workers that we've been seeing, particularly in the lower income part of the population, wages have been rising, and I would expect that to continue. Now, of course, yes, you have to consider the pace of wage increases relative to the pace of underlying inflation to back out that real wage number. And right now it is a bit more problematic, but I think into next year you get some cooling in some of these components where inflation has just been extraordinarily high, and meanwhile wages continue to creep up, and I think that's a favorable backdrop.
I look where we are, Michelle, and I've got to interrupt the train of thought here. When we see yen go out through 112 onto 113, dovetail Bank of America foreign exchange analysis into your great American economic view. How does strong dollar change your calculus?
Well, look, the strong dollar presumably is a function of the fact that it's a strong economy. So I would argue that the dollar strength that we've seen has not been unwarranted or unsupported by the fundamentals in the U.S. economy. But yes, of course, when you think about the FX moves, you think about the balance of trade, you think about the cost of goods, and all of those things are obviously going to be impacted negatively when you have a strengthening in the dollar. But I would argue, and very much with our FX strategists believe, that the move in the dollar is justified given what you're seeing in the U.S. economy.
So before we let you go, Michelle, we've heard a lot of Fed speak over the past couple of days, and it will continue today. Fed Chair Jay Powell on the Hill. Is there anything that he has said over the past couple of sessions that we've heard from him that's been of interest?
So, you kind of always have to read between the lines, and I think that there's been a real emphasis on the supply side of the economy. Because it seems like there's this discussion within the Fed over whether or not all this demand side policy, very accommodative monetary policy that stimulates the demand side, is the right prescription if you're really facing a bigger supply side shock. So they're trying to figure out how permanent the supply side issues are And one of the ways to gauge that, frankly, is just to go back to inflation, which you talked about before, Lisa, particularly long-run inflation expectations. The extent to which long-run inflation expectations move up will tell the Fed that they have a more permanent constraint on the supply side, and that will prompt them to pivot when it comes to dovish monetary policy. They're not seeing it yet, but they're obviously very, very, very keen to focus on this topic and looking at it very carefully, which makes a lot of sense.
Michelle, happy Christmas to you, to the family. Thank you.
Happy holidays.
I love that note. I really do. Michelle Meyer, thank you so much.
She's dragging her kids out to see Santa
Is she lying to them,
October 5.
pretending that it's October 5th, Tom?
Yeah, you know.
From Bank of America, but the wonderful Michelle Meyer. Tom Keane, there's a breakout in the dollar. We need to talk about it. Euro dollar, there's a breakdown. 115.69. We're talking about the strongest levels for the US dollar so far this year. A 115 handle on the euro for the dollar index. It is a 5th straight day of gains. That's a 1.5% move, Tom, over 5 days.
Yeah, that's how you do it, John. You've got it right. It's a big figure move, and it's what matters. What I would do, John, and folks, this is really important. You look at the major pairs, and then you look at cross rates, the less major pairs. Think Steve Englander in his abilities there, many others as well. And the answer is you look at those nuances. And John, we have the huge advantage of the Bloomberg in our face where we can look at those nuances. And I'm sorry, John, those nuances are sustained dollar strength.
This move has caught people really wrong-footed. A little bit later in the next hour, we'll catch up with Jordan Rochester of Nomura. Looking forward to doing that. Euro dollar 115.70. We're negative there.
Is he here to comment on Aston Villa or Chelsea?
We can get an Aston Villa comment from him if you want, Tom.
I mean, the only reason we booked him is to talk about the Tots
to
and
talk
Aston
about
Villa.
Midlands football in England. Looking forward to it. Up 17 on the S&P, advancing 0.4%. Looking to round out Q3 with you and get Q4 started tomorrow. From New York City for our audience worldwide, good morning. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Congress is cutting it close in an effort to avert a government shutdown. The House and Senate are expected today to extend government spending to December the 3rd, just hours before the new fiscal year begins. Meanwhile, deal-making continues on the president's economic agenda. The House plans to vote today on that infrastructure package that underscores deep divisions amongst the Democrats. The G7 economies are looking for ways to restart international travel. Bloomberg's learned that transport and health ministers will meet virtually today. The meeting is aimed at moving closer to a consensus on how to ease border restrictions. Some countries, including members of the EU, have used so-called vaccine passports. Others, like the US, have held back for reasons ranging from politics to privacy. China is applying its zero-tolerance coronavirus strategy to next year's Winter Olympics in Beijing. It's limiting spectators to those residing in mainland China who meet the requirements of COVID countermeasures. Meanwhile, Olympic athletes who are not fully vaccinated will be quarantined for 21 days once they arrive. In the UK, the global semiconductor shortage slammed auto production in August. Automakers produced 27% fewer cars than they did a year ago. The head of a trade association said the impact of the chip shortage cannot be overstated. Battery, electric and hybrid models made up almost a 28% share. That's the most ever. Bloomberg's learned that electric truck startup Lordstown Motors is near a deal to sell its Ohio car factory to Taiwan's Foxconn. Lordstown bought the highly politicized plant less than 2 years ago from General Motors. A sale would allow the company to raise cash and operate alongside Foxconn, which wants to speed up a push into EVs. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.